but does not send a clear signal that they're going to come, the first rate cut is likely to come at the March meeting. I think very clearly they're highly data dependent. We get a lot of inflation data between now and then. And if you get inflation data that continues to support the idea that it's coming down, substantial disinflation, they can cut rates, certainly then they can walk through that door at the March meeting.
Matt, you and I have talked about this phrase, passive tightening. What is passive tightening? And is it something they try and address in the news conference today?
I think no doubt, how they've been laying out why they're going to be cutting rates under a soft landing scenario. It is a concern that as inflation comes down, that real rates rise too much and that it could put the soft landing in jeopardy. I think it has a really nice tie-in to the events of today. We're coming from an economy that looks very resilient, strong growth, labor market is strong, consumer spending is strong. But at the same time, there are risks out there. If interest rates remain elevated and higher for longer, it does suggest that those risks could manifest. It could put the soft landing in jeopardy. And, so certainly at the margin, the events of today do argue for adding some probabilities to rate cuts as early as March.
This actually is exactly where I wanted to go, Matt. This idea that New York Community Bank Corp could single-handedly tip the scales for the Federal Reserve. Do you think that this is exactly the narrative shift that they've been looking for because they've been looking for an excuse to cut anyway?
No, I don't think they want to see banking stresses as an excuse to cut rates. I think they'd be quite happy to cut rates simply because inflation's coming down, and they can allow kind of allow that to play out and to support the soft landing. But it does make the decisions clearer. It's a little bit more ambiguous or more difficult in an economy growing above 3% with a 3.7% unemployment rate and consumer being robust. There's kind of key arguments on both sides. If you do see some of these stresses emerge, it does make the decisions easier.
Can they paint this as something of a positive for the economy, as passive tightening, if they use some of the stresses that they're seeing in specific places as a reason for their caution and their potential actions?
I don't think you will hear Chair Powell, highlight, the banking sector stresses. I think they will continue to think about it as sound and resilient. I think internally, as they're thinking about those discussions and decisions, it just gives them, some caution, and it does indicate that there are still risks out there, and that they can help to, I think, solidify the soft landing by beginning to bring down rates. As they, publicly talk about why they're cutting rates, I think it is all about inflation coming down. It's all about ensuring that policy does not become too tight over time. And it's all about solidifying the soft landing that looks to have really grown over the past several months.
Priya Misra is still with us from JP Morgan Asset Management. Priya, just how mechanical is this? As inflation starts to come down, how concerned should they be about so-called passive tightening?
I think they should. I think academic models, etc., all argue real rates is ultimately what impacts the economy. It's just a hard one to explain to everyone, to the market. So I think that's why Chair Powell, I think that's the focus of the press conference today, to explain that passive tightening, to talk about what does real interest rate mean? Why is it that important? And then to talk about how restrictive monetary policy is. I think they've suggested that it's well into restrictive territory. We need a more definitive answer. They need to remove that tightening bias from the statement. Say policy is restrictive. We don't want it getting more restrictive. Let's just start the normalization process. I think that's an easier way to message the passive tightening than go into real rates. I know as much as you all love real rates.
Well, the real rates are great, but the answer is our audiences on radio and television are dealing in the real economy here right now. Dovetail this, Priya Misra, with the work of Michael Ferroli and Bruce Kasman and the basic idea of the IMF the other day with 1 year, 2 years, 3 years of what any and all Americans, including Biden and Trump, would say is subpar GDP. How many cuts do they have to come down just to catch up with what the IMF's modeling out?
Great question, because as much as we're all focused on March or May or June, it's the total amount of cuts that the yield curve is sort of discounting. And we're pricing in the endpoint after the cuts at 3.25. That's still north of what the Fed argues neutral is, which is 2.5. So I think it's about the total amount of cuts. In a soft landing, 200, 250 basis points of cuts are completely reasonable. So there's more room for 5-year treasuries to decline or real rates to decline, even in a soft landing. In a hard landing, they have to go into accommodative territory. That's 2%, 1% Fed funds. I think just having those two scenarios in mind can sort of guide or put guardrails around where interest rates should go. But I think we're talking at least 200 or 250, even in a benign growth environment, which is what the IMF is projecting out.
Matt Lazzetti, I know we've got a few more minutes left with you. Can we just get into the details of the statement before it comes out in about 7 minutes? In the third paragraph of the statement back in the middle of December, there's this line about the committee determining the extent of any additional policy firming that may be appropriate to return inflation to 2%. Just still implicit in that is this bias to tighten maybe a little bit more if they need to. Does that get dropped today, Matt?
You're right. That's exactly where we should be focused within the statement. It's the key. We do think it gets dropped. We think that they drop the explicit tightening bias. They go to something more generic, kind of talking about policy adjustments, which kind of hints that they could go in either direction. But really, I think that is the precondition. Dropping that language, dropping the explicit tightening bias is the precondition to open up rate cuts as early as the March meeting. And that'll be the focus, I think, at 2 p.m. Do they drop that or not? And we think they do.
Hey, Matt, we'll look out for that in 6 minutes' time. I know you've got to run. Matt Lazzetti there of Deutsche Bank. Priya, we can continue that conversation. Would you look for the same change? And will that set up a bigger conversation in the news conference about pulling back QT?
Absolutely. And I hope he's asked about QT as well, because, Dallas Fed president brought it up. Maybe they need to start tapering QT. They're trying to finesse the level of the balance sheet, and they're getting close to low levels on RRP. So I think this whole idea of normalization, if the Fed opens the door, they remove the tightening bias, and then I think asked about whether dot plot had 3 cuts, what would be the baseline today? And Chepal's not going to answer that. But then to try and get a sense of if they were to start, is it at 25 basis points? Is it in line with tapering QT? I think just trying to understand the reaction function on the balance sheet and rates, and at different levels, right? I think at 5.5, it's easier for them to start to cut, and becomes a little harder as they get those rates down closer to 3%. But I think that's going to be the focus, just trying to understand that reaction function today.
Priya, it's off your remit, but we saw ECI finally lighten up a little bit today. We got a jobs report coming up on Friday. Where are we going to be Monday morning?
There's a lot this week. It's a very big macro week. But I think the jobs report will be an important number, both the average hourly earnings and the number, to get a sense of, is the labor market slowing? I would say the labor market tends to be often a lagging indicator. So if policy is restrictive, we think things are slowing. Whether it shows up, it's a noisy number. Whether it shows up on Friday or not is harder to tell. But I think, what's the message from the Fed today? Are they open to normalizing policy, starting the process of normalization? How is the economic data? What's the fallout of New York Community Bank? Is that one bank that needs capital? Or are there these problems across the regional banking system that the market starts to fret about? We've got this new wrinkle, which is actually not such a new wrinkle given what we lived through last year. And remember, the BTFP program runs off. So this cheap funding that banks had runs off in the middle of March. And so does the discount window start to get used? So there's a lot. Come Monday morning, we'll be looking at the banking sector, the economy, and then trying to assess, is the market pricing in the correct Fed reaction function?
Well, Priya, I'm glad that Tom went there to all of the things that can happen, because we've been seeing just narrative shift after narrative shift. And earlier this morning, we had several guests on who are talking about how the biggest risk is actually a reacceleration of inflation later this year, whether it's Wei Li of BlackRock or whether it's Sebastian Page of T. Rowe Price. All of them have the same fear. What are you seeing that makes that less relevant if people are looking at the strength in every single outlet, regardless of, yes, one pocket? What are you seeing that gives you confidence that we should focus more on New York Community Bank Corp, more on certain weakness and some peripheral indicators?
So maybe it comes from my thesis that monetary policy is restrictive, because I look at long end real rates. I look at the fact that the balance sheet is shrinking. So, we talk about easing financial conditions, but it should be viewed, it's context dependent. It should be viewed relative to where the economy is. If inflation's at 2%, yes, financial conditions have eased, but they haven't eased to the point where they start to become accommodative. If we were in accommodative territory, absolutely, there's reacceleration of inflation risk. I think we went from very tight financial conditions to less tight financial conditions. Monetary policy is still very restrictive. So where does that inflation reacceleration come in? Now, I'm watching wages. I was nervous before ECI because it's been running higher than average hourly earnings. And if that number had come in 1.2 quarter-over-quarter increase, okay, then it's a little nerve-wracking because our wages not coming off. Wages are coming off, rents are coming off. A lot of the higher, goods inflation is already in deflation. So when I look at service inflation, inflation. I don't see signs of that re-acceleration unless the Fed goes crazy and goes to like 1% in the near term, which is unlikely. They're cutting slowly, methodically. So we really need easy conditions, I think, for that re-acceleration. I don't see those easy conditions here.
Hey, Priya, great to catch up with you. Priya Misra of JP Morgan Asset Management, 2 minutes out from that Fed decision. It's interesting the way we started the conversation this morning and how it's developed as we've approached this decision. The conversations we had this morning, Bramo, Chair Powell's going to be non-committal in this news conference. What we heard from Matt Lazzetti at Deutsche Bank is that they've got to set this up in the statement and then in a news conference going into March and maybe beyond.
And people earlier this morning were saying maybe that's going to be a mistake because there is this strength that could cause inflation to reaccelerate. Now people are saying, get on it. Why don't you cut now? Because basically you're getting a green light with signs of things being pretty tight.
I think the green light here is the markets are on the move. To have Priya here on the Fed decides it's really key to get in front. I wish she was in the press conference asking her own questions. I got a 171 10-year real yield. That was unimaginable, John, 24 hours ago.
We'll catch up with Mike McKee in 60 seconds. 60 seconds away from that decision from the Federal Reserve. Here's the state of play in financial markets at the moment. In the equity market this afternoon, on the S&P 500, we are lower by 0.7%. On the NASDAQ, we're down by 1.1. I did not think we'd be talking about New York Community Bank and the bond market today, but we are. Lisa, Treasury yields lower by 10 basis points at the front end to 4.24.
And how many people have said community banks are fine, they're successful, they're not going to fail, they're not going to show cracks. New York Community Bank comes out and has a loss and suddenly cut rates sooner because that's basically a sign the stresses are getting too great.
Just shows that people are still on edge about this issue.
100%. I think people have not realized whether you've seen the shoe to drop, and commercial real estate is still a very big question mark, particularly in certain urban centers.
The 10-year yield down by 7 basis points, 395.77. Just to finish on foreign exchange, the euro looks a little something like this against the dollar. Euro-dollar at the moment, 108.47, totally unchanged. With your Federal Reserve decision, here is Mike McKee.
Risks to the economy are now balanced, the Fed says, and they're no longer talking about raising rates, but do not expect cuts soon. No change in rates today, and the statement drops the reference to additional policy firming, now saying, quote, in considering any adjustments to the target range, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. But before you buy March futures, the statement goes on to say, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. Officials say the economy is solid, job gains remain strong, and the committee judges that risks to achieving its employment and inflation goals are moving into better balance. Inflation, however, has eased over the past year but remains elevated, the statement says. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. There's no change to balance sheet policy, nor does the statement suggest any changes are imminent. The Fed will keep the $60 billion cap on Treasury roll-offs and the $35 billion cap on mortgage bonds. The decision today, unanimous. And one other bit of business, the Fed has extended its tighter policies on investment and trading to senior staff and any staff with access to confidential information.
Mike McKee, thank you, sir. Let's get to the price action immediately and look at equities. Equities on the S&P 500 just a touch lower by almost 1% on the S&P. On the NASDAQ, we're down by 1.4. If you just turn to the bond market briefly, yields were lower by about 10 basis points to the front end. Now 425.61. That moved face just a little bit. So, Lisa, let's go through what we got here. We've dropped the tightening bias, but not a full embrace of the rate cut conversation taking place on Wall Street.
And there's a little bit of disappointment clearly that you can see on the front end with people maybe thinking they would lean into a March rate cut, saying not thinking anytime soon, highly attentive to inflation risks. That focus may be casting a bit of cold water on some of the hopes and dreams.
The TK down 5 basis points on the 10-year, just short of 4% here at about 3.98.
Coming a little move here, John, and I still say we're radically different from where we were earlier this morning, or even days ago. Yes, we pulled back a little bit. It'll be interesting to see the press conference, to say the least. This is well timed. Joining us now is Richard Clarida. He is with PIMCO, their global economic advisor. He's the former vice chair of the Fed and far more associated forever with his Columbia University. Richard Clarida, Ethan Harris, student of Columbia, ex-Bank of America, wrote a brilliant piece off his hero at Columbia, Phil Kagan the other day, and he said, we've blown it on our inflation studies. We've got to get on trend. And for him, the trend is the Dallas trim mean, the Cleveland median, and the rest of it. What is the trend right now, Professor Clarida, in inflation?
Well, thank you for having me on, Tom. Good friend of Ethan, and Phil Kagan was a colleague and a friend for many years. I look at Dallas Fed trimmed mean 2. It's running somewhere in the mid-2s on an inflation. That's down a lot from a couple of years ago, but still obviously somewhat above the Fed's long-run goal of 2%. But I think that's a good reading right now.
Rich, when you look at the pushback, and it is subtle pushback in this statement, why do you think this Federal Reserve is not quite prepared to fully embrace that rate cut conversation taking place on Wall Street?
Well, on this one, John, I actually agree with them. I myself, looking at the data they're looking at, would have thought March would be too soon. We don't get a lot more data in March than we have today. Moreover, as you've pointed out on air, and I've been watching, you know, there is still some upside risk on the inflation picture. So I just think good policy prudence would call for getting more information, and I applaud what they did in the statement today. They did. I don't have it in front of me. I read Mike's account. Looks like there's a lot of red ink in it, and I think that made sense today.
Yeah, especially with that particular comment. The committee does not expect it will be appropriate to reduce the target rate until it has gained greater confidence that inflation is moving sustainably toward 2%. I'm wondering, Rich, do you think that the New York Community Bank Corp issue changes the equation, even on the margins for the Fed, and if you were on the Fed, for you?
Given what I know right now, Lisa, I would say not, but I do think that the reality is that you know, we have a number of regional banks in the U.S. you know, above 100 billion, but not in that mega category. And the Fed did what it needed to do last spring, and I have no doubt that they will be there if further is needed. So I'd say right now this doesn't appear to me to be systemic, but whenever banking is involved and you see an unexpected loss, it certainly is on their radar, and I'm sure it is.
Rich, as you know, as we know, a lot of thought goes into the language that gets put in this statement. That line, greater confidence. A lot of people are going to stress test that line, greater confidence, for the next 1 month or so. Neil Dutter, our good friend over at Renaissance Macro, writes in, what exactly does greater confidence mean? Can you talk to us about that, Rich? What do you think greater confidence means? And I'm going to ask this question just to wind up TK. Is it 1 CPI print? Is it 2? Is it 3? Rich, what is it?
Well, I think, you know, at the risk of exaggeration, you might have 19 opinions on that on the committee. I think the center of gravity, though, look, the price inflation numbers have been moving in a very good direction. 6 months now, core inflation or Dallas Fed measures are definitely close to 2%. But we do have an economy in which wage inflation is running about a point hotter than probably they think would be consistent with the long-run goals. So I think implicitly they'll be looking at a number of indicators from the labor market. We got some good news today on ECI, but even with that, ECI is still probably about a point hotter than they would ultimately like to see.
Rich Clarida, measured. I'm going to associate it with Alan Greenspan. You may want to take it back further. But I'm sorry, we are slaves to measured in our great fear of becoming unanchored. We have regret. We're worried about the Bank of Japan. I believe it was back in the early 2000s. We need to be measured. How do we be measured after this pandemic and after this original economics?
Not surprisingly, good question there, because measured was used by the maestro in 04 to talk about a measured pace of rate increases, but certainly now it may enter the conversation once they start to cut. And I think here you do see the tug of war. Folks look at past history. They see that when the Fed starts to cut, it cuts very fast and in big chunks oftentimes. Typically, if you go back and look, Tom, in soft landings, and what turn out to be soft landings, it looks a lot different, more like 2 or 3 cuts, 75 basis points or so. So I think a lot of the measured in this cycle on the down direction is going to depend upon how soft the landing is. Jay Powell thinks the runway for a soft landing's in sight, but right now that's a forecast. So it will be data dependent. Sorry, that's a cop-out, but I do think that it will be data dependent.
Can the Fed afford to be measured?
Like a Fed official.
Well, I mean, can the Fed afford to be measured and start later if we're also bumping up against a political silly season, as Tom would say? This has become something that more and more economists are looking at. Why not start early earlier, go more slowly and be less susceptible to becoming a political football.
Yeah. Great point. It is an election year. I noticed historically, and you can confirm this on your Bloomberg terminal, historically the Fed has moved in election years in both up and down. So I think the Powell Fed will do what it needs to do this year in terms of adjusting rates, presumably downward. But I do agree with you, Lisa. You know, if you think you're going to cut 3 times, say, which was what the December SEP was, certainly it would make sense to get that process going, you know, perhaps in the summer and not wait till November, shall we say.
To dovetail with the academics of Richard Clarida joining us now from the Midwest, Diane Swank of Michigan, Chief Economist, KPMG. Really pleased to have you here with Diane. Let me get away from the monetary mumbo-jumbo, Diane. You are expert on the pulse of corporate America, on this technology overlay we've witnessed. Look at the profits of Microsoft yesterday, and also on this new change in productivity. Does this Federal Reserve have any understanding of the new productive America?
I think they do. I think they're watching it very carefully. What the question is it something that's sustainable? And, you know, this is why I agree 100% with Rich, the measured concept, because I think the markets really want to see much more aggressive rate cuts. And the Fed, I think they start in May. But I think what's important about it is they start before the second half of the year, before we really get into the summer. And I think that's going to be justifiable. But I really think it's important to understand what's going on in terms of productivity growth picked up in part because people are not quitting jobs as much. They're learning the jobs they had. We're also finally leveraging all that technology that we took on as we pivoted online. That's all good news. The question is, how sustainable is it? And I think that's something the Fed still hasn't figured out, and that's what we're going to see in the minutes. I mean, it's really interesting to me that the December meeting, when Powell came out and had a much more dovish tone and was pretty excited, and markets got pretty excited off of his comments. The actual minutes to the meeting were that, you know, hey, we're worried that inflation risks are to the upside. And so it'll be really interesting to see the minutes off this meeting in terms of how they see the productivity growth continuing in 2024. And, you know, it's a cop-out. The Fed gets to be able to react and be data dependent, and Rich is absolutely right about that. But that's what they're going to do. They're looking at a meeting-by-meeting basis. And I think, you know, we'll have enough information by May and June to begin those cuts. But I think that measured side of it is also really important because the markets really want to take off and put a lot more cuts in than the Fed is really willing to do.
It was a really bizarre sequence to have the chairman engage in a conversation about interest rate cuts, then New York Fed President John Williams come out and say, not really talking about rate cuts, and then the minutes seem to back up Williams and not Powell. Diane, we'll let it go. Let's see if they repeat it again. I think, Diane, today there's a feeling they are going to engage in a conversation a little bit more openly about the timing of interest rate reductions. Do you think they need to draw a clear distinction between adjusting rates and easing policy?
Yes, absolutely, and I'm sure Rich would agree with me. I mean, this is removing the restriction, but not trying to stimulate the economy, and I think that's very important. They're trying to normalize rates. They're not trying to stimulate a moribund economy, and that's a very different scenario, as Rich pointed out, from a soft landing and what may be, at the moment, an extremely soft landing. We also know that, you know, we're kind of coming in really strong in the first quarter on consumer spending, even with January and some weather disruptions. You don't need much consumer spending for it to be very robust in the first quarter, and that's something the Fed's very attentive to right now as well.
So in the press conference, most certainly, Rich, there's going to be someone who comes up and asks Fed Chair Jay Powell, so how much did you guys talk about rate cuts? Did you throw out dates? Did you throw out what your criteria are? If you were on the Fed, what would you hope he would say? How granular should they be, given the fact that people know they're talking about it? They have to be talking about it. Everybody else is talking about it. How much do they really telegraph to the market?
Times, Lisa, when the press conference is, you know, moving beyond what was in the statement, sometimes because the chair wants to move in that direction or because you've got a divided committee. I think today, and of course we'll find out in 2:30, I think today is a day when the chair on that question in particular will hug the FOMC statement pretty closely, because it was a big change from December. Some of it was expected, some of it was a little bit more hawkish, and so knowing Jay Powell, I think today will be a day when he gets a question like that, he will hug the FOMC statement language pretty tightly.
That's what you do with Bramo questions. Just hold on to the statement, try and ignore the question. I just wonder how many times they shared the love letter from Senate Banking Committee Chair Sherrod Brown and the letter from Senator Elizabeth Warren and her Democratic colleagues. Rich, you've got experience of this under the Trump administration. It's often, and I'll say it for you, it was inappropriate then, it's inappropriate now. How did you deal with it then? How do you suspect this FOMC will deal with it now? As you see lines like this from senators down in Washington, D.C., that I urge the Federal Reserve to ease monetary policy early this year. How do you deal with that, Rich?
Obviously, we had to deal with it in a different context, but it goes way back, and I think Fed institutionally and Jay Powell individually understands the stakes, and I think he just thinks this is just part of the job, and the Fed will look through it, and of course the data is breaking in a direction where that completely reinforces it.
Richard Clarida, though, this is a good time to mention, of course, this is your public service to the nation, is with John Snow in Treasury, Paul O'Neill, and your work, of course, as vice chair, recently anointed by the Museum of American Finance with the Whitehead Award. And I'm going to go back there to Paul Volcker and others. I'm sorry, Richard Clarida, at the end of the day, you were teaching Politics 101 at Columbia. This Fed has to go into an election cycle no one watching or listening has ever seen. How political does the Fed get, say, Labor Day?
I think the Powell Fed will not be political, but it's inevitable monetary policy will be pulled into the political presidential discussion. I think they're prepared for it, and I think they have decided, or they're deciding what they think they need to do based on the economics, and when they're ready to go, they'll communicate it. I'm confident they'll succeed, but I don't disagree that there's going to be enhanced emphasis and focus and a political element to the focus on this.
In the meantime, there's a real question, Diane, about what exactly greater confidence means, as John was talking about earlier. What metrics are you looking at? I was struck by doom spending, which of course caught my eye, but some of these areas that might be distorted because of changes post-pandemic. What gives you the clearest read?
Well, I think you're just going to have to continue on the labor market and inflation. Those are the two most important things. Those are the two most important data points to the Federal Reserve, and that's what they're going to be watching. I want to just echo something that, Rich said. We've seen Powell go through some pretty hard political times already, and he's proven himself to be an institutionalist with the Fed on that, and I think that's a positive thing. The Fed doesn't have a horse in this race. That said, they will be blamed for no matter what they do, no matter what, and they know that. And I think that's what Rich is telling you, and that's, that doesn't mean their decisions are going to be influenced by it. It just means that they know how to go through the hailstorm that's about to hit them. That said, they're looking for continued improvement in inflation and continued improvement in services inflation. I think they're going to get it. And I think they will be moving by May. But the bottom line is they want to see that continued improvement. And they're also watching the consumer out there pretty closely, because this has been a remarkable, not only resilient consumer, a defiant consumer, showing just how strong they really are.
Diane, Mike McKee is still listening. Before he goes into that news conference, questions for Chairman Powell. What are they now?
The biggest questions are, how do you talk about what is that exact issue is, what does this mean when you guys feel confident enough to cut rates? What is going to be the criteria? That's what all the focus is going to be on. And my guess is he's going to talk about it very vaguely, and that's the problem for financial markets, because they want something concrete. And this is when you get, and ask Rich about it, but you get to the hard part between monetary policy as a science or an art.
This is the art at the moment. Diane, thank you. Diane Swank there on the latest. Let's reset here. If you are just joining us live on TV and radio, it is a special edition of Bloomberg Surveillance, The Fed Decides. The news conference is in about 13 minutes' time. We had the decision about 17 minutes ago. No change on interest rates. They dropped this bias towards further tightening. There's this new line we need to talk about. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. So this is the market response to all of this. Your equity market this afternoon looks like this on the S&P 500. 500, down by 0.9%. We're down 1.3 on the Nasdaq. Lisa, in the bond market, yields lower by 8 or 9 basis points. Not session lows on bond yields, I have to say. This move faded just a touch. So the market is looking at the Federal Reserve, hoping they inch towards interest rate cuts. They're kind of taking a baby step today, but not fully embracing the idea just yet.
The fact that they sort of said there's still a prolonged period of time before we reach our inflation targets cast some cold water. There still were people out there who thought maybe we'd get a cut at this meeting, right? That it was a live meeting. We heard some people saying that's what they should do, right? This casts some serious cold water on it. I love the idea of what we're going to hear from Jay Powell. Absolutely nothing. He will hug that statement. He will say as little as possible. He will be as ambiguous as possible. Just wait for it.
I think we could get a surprise like last time, and I think Diane Swank was absolutely right about the science and the art. John, we're coming out of a pandemic. The great missed call last year was economic growth. Where were we 12 months ago? Doom, gloom.
Totally, nailed it.
Total gloom. Everybody was wrong. I was wrong. Everybody else was
Lisa's
wrong.
taking this personally right now.
I don't see it.
Tone it down.
You know, it's great in the new studio. The Bramo cam looks beautiful. But the point here, John, is it is an art. They're making it up as they go after this massive pandemic and massive stimulus. So I think today is less predictable because I was humbled last press conference.
Tom, it's important to pause here, and I'm pleased you've brought it up. It's important to pause and go over where we were, where we thought we'd be, and where we actually are. Where we are right now is unemployment at the 4%. Inflation's doing better. Core PCE last week, we were talking about a 2 handle, not a 3, which is a massive change as well. And GDP, Tom, growth held up in the face of interest rates climbing aggressively. Now, this is not a judgment about where we're going. This is just an observation about where we are. And where we are is so much better than where we thought we'd be 12 months ago.
Greenspan 101, I mean, forget about measured. We have a stock market which is voting every day, every tick. And I believe since October has been on a tear. They have to fold that into the debate as
Just
well.
pulling back from all-time highs. Robert Tipp is with us of PGIM Fixed Income alongside the former Fed Vice Chair Richard Clowder. Robert Tipp, you've had about 20 minutes to go over this one. Your reaction to it?
Sure. Yeah. You know, where we are versus where we expected. I mean, we did not have a backdrop for a recession. Interest rates were raised for a reason. The system had a clean backdrop. It was not one of these backdrops that was going to crumble when interest rates were raised. It continued right through SVB. The economy has plowed through. And the Fed is fine-tuning the policy at this point. Now, they started off with the first notion of cutting rates. I mean, arguably back in July, Powell talked about how they would not wait for 2% inflation. They would be cutting way ahead of that. Now, September saw a huge U-turn, so they were fine-tuning with maybe like a chainsaw at that point. December, you know, they came in and we had a U-turn, and a U-turn, frankly, before that in October, they called an audible as rates went up to 5%, and they started to talk down their own higher for longer. At this point, they're really balanced. The market wants to get 200 basis points ahead of them, which is actually kind of understandable. The 5.3% Fed funds rate they're running right now is a long way from the 2.5% that they're putting forward as neutral. And inflation is hundreds of basis points off its highs and pretty sustainably, you know, is down in the 3s, if not down at target right now for about 6 months. So their comments, you know, suggest they want to see a few more months, or maybe a big team of them want to see another 6 months before they go.
Robert, from the parlor game, let's go to what you and Greg Peters do every day, which you've got to be in the market. Are you being in the market clipping the coupon, or can you actually still pop a good total return this year?
Yeah, I think big picture, the market is going to clip a good return. I think that your spread products, you know, as we've said, starting off, put out a piece at the end of 2022, yield is destiny. You are going to clip that coupon. But we've seen the market 75, 100 basis points on either side of 4%, roughly. And I think we're going to continue to see these big swings. Right now, the market wants to go in the dovish direction. But this Powell Fed is aware that the second big move higher in inflation in the 70s came with hostilities in the Mideast, with volatility in the Middle East, and a big increase in oil prices. And we have full employment around the world. We've seen very high inflation that brought about higher wages. All of that is in retrograde right now. They're going to want to make sure they have that really under control before they turn aggressively here.
It's a good point, Robert, and I expect that we will hear from Fed Chair Jay Powell. They are watching the issues and the conflict in the Middle East carefully. Rich Clarida, one thing that was really notable about the December press conference was that Fed Chair Jay Powell had an opportunity to push back against that rosy outlook, the sort of flooding into risk assets that Robert Tipp was talking about and that so many people have embraced. He didn't push back. Do you think it's going to be the same at this press conference, that he will just say, ultimately, the markets will do what they want to do, we're watching something else, and we're on a good glide path?
Again, I think this is going to be a press conference where it will make sense for the chair to really hug that FOMC statement. There was a lot of red ink. It was there for a reason. It gave the message that, basically trying to dissuade folks from pricing in that March adjustment and talk about they want to see the considerable and additional evidence. And so I think that's a pretty good place for him to spend most of the day, at least on those sorts of questions.
I have to say, Rich, you're not hyping up this news conference at all. It sounds like Chairman Powell on repeat. I appreciate the honesty, though. Robert Tipp, just finally, I'm getting a load of people right in to say, what's the trade? What's your favorite trade right now, Robert, after what you've just heard?
Yeah, I think that it's not that whether the cuts priced in are correct or not. I think it's the timing and the shape of the curve. The ends of the curve, whether you're looking at the next 6 months or whether you're looking at the 10-year or the 30-year point, those look more reasonably priced than some of your 2-year out interest rates that are really banking on 200 basis points of interest rate cuts in the next 18 months. And I think if you can stay in the market and clip that coupon, avoid rolling up the yield curve, and also make some money on the tactics of trading this wide range on rates, I think it's going to be a very good year for bonds.
Robert Tipp, thank you, sir, from PGIM on the latest from the Federal Reserve. For more, here's Bank of America's Mike Gapin, the chief economist. Mike, you've got the Fed going in March. Do you like what you hear today? Are we making that closer step, another baby step towards your call?
We are. I think you can interpret the statement as saying risks to the outlook are balanced, therefore our guidance should be balanced. And then did we debate a rate cut today? Yes, we did, just not for very long. What we need is more confidence before we cut rates. And I do think that involves seeing more progress on services inflation and more progress on wages, because as you know, a lot of the disinflation has come from goods prices. Those declines may not persist. So the Fed will see more of that data. I think they can get there by March. So I'd say the statement was broadly in line with our thinking.
Michael Gapin, how aggregated are we or disaggregated? Are there two Americas out there, an America flat on its back, and then the prosperous Americas witnessed by Microsoft's profit yesterday?
Yeah, there is, the economy is bifurcated. I think more broadly, you could just say, industrials and goods versus services. The industrial side of the economy has been suffering. Regional banks, obviously, with news headlines this morning, still continue to struggle. But the consumer's in good shape. The services side of the economy is doing well. Tech earnings are doing well. It has been kind of a rolling recessionary story where certain segments of the economy have had problems at different points in time, but the economy overall has powered through. So thinking about it in that way, Tom, I think makes a lot of sense.
Michael, I love hearing the bustle and the hustle behind you, and I imagine everybody's saying the balance of risks. How do we get the greater confidence that inflation is coming down? What does that mean? So what do you think that means in terms of how much you've got to get in terms of data under belt?
So I think they can get there by March in the following way, in that they'll get February PCE, and they'll get the CPI and the PPI for that next PCE, the January PCE, but then they'll get CPI and PPI for that February PCE print during the blackout period. So they'll have two more inflation reports. They'll get more information on where is services inflation, where is shelter. They'll get more wage data in the next two employment reports. I really think it's about that side of the ledger for some on the committee. For Governor Waller, he says the components don't matter. I just look at inflation. So his bar may be lower, but others are really kind of concerned about that good services trade-off and worry that services are too sticky.
In a word, optionality. It's written this way. because it can mean whatever they want it to mean, Lisa, at any time over the next few months.
Which is the reason why he's going to hug that statement so close, and everyone's going to be happy. And then
someday I'm going to read a statement or read the minutes, and it's going to say in there, "It is written." It's going to actually say it in there from Game
Richard Clarida, let's come to you and just wind things up and put a bow on it if we can. This has been a single mandate central bank for the last couple of years, with a focus on inflation and getting it back down towards 2%. Can we talk about the other side of the dual mandate? Is there anything to worry about in the labour market from your perspective?
The labor market is in a very good place. If anything, it's running a little hot, but I do think there's a path for that to adjust under the outlook. So yeah, the labor market is, that's what we want: maximum employment. We're at perhaps a little bit more than maximum employment, but wage inflation is decelerating. We saw in the ECI, and I think that's what they're factoring in for this year, continuing that.
Michael Gapin, do you agree?
I do. I would say if concerns would be about the dispersion of employment growth, which is pretty narrow, focused in leisure and hospitality and education and health, and then remaining growth in the private sector is basically flat. But I agree with Rich. The labor market's in a good place, and it's helping to drive the outlook.
Mike, I know you've got to run. It's great to get your call. Michael Gapin there of Bank of America, looking for a March interest rate reduction. Richard Clarida, thank you, sir, and congratulations on that Whitehead Award. Truly prestigious, sir. We appreciate your time. Let's round things up. Neil Duff of Renaissance Macro writes in again. If they wanted to get rid of March, couldn't they have gotten something with some teeth, like we need a few meetings, as in plural, to establish confidence? This is weak source. How this was tailored for me. This is weak source or T in your case.
Okay, look, they didn't want to give anything definitive. They don't want to give the market anything else because they want to maintain optionality. Basically, they want to be able to pivot on a dime if something comes up. And frankly, what we heard there from everyone is that each Fed member has a different view in terms of what the threshold is to have them vote for a cut.
I think I'm going to go back to it. I think Swank absolutely nailed it of science and art. Forget about the books. I was talking to somebody today about a textbook, John, from Central England called the Pentecost. Algebra, geometry, and certitude. There's no certitude here. There was a pandemic. And the smartest chart I've seen in the last 2 weeks is Steve Ratner. He had it out at Morning Joe. And it was this great chart, John, of the shock recovery in employment. None of us guessed that. That's what they're dealing with.
Bruce Kasman of JP Morgan Asset Management, JP Morgan rather, a little bit earlier, I think absolutely nailed it. The door's open. And they've left it open today. It's up to them when they want to walk through it. We'll get revisions for inflation, a few more reads. We'll see where we are in March, Bramo. But at the moment, they want the optionality. Based on what they've written in the statement, they've got it, haven't they?
They don't have an upper hand, right? This is the thing. Everyone's debating where we are in the economic cycle. They don't know. So they want some sort of, smoke signal, and then they can go. But this isn't typically what markets like, because they definitely want something definitive rather than flipping and flopping and moving around the table.
I would go back, and I'm not a fan of this linkage of politics into monetary ballet. But, John, I'm sorry. There's an election. It seems to be tumultuous. I think that's my briefing from Anne-Marie Horton. So the answer is they got to start in March to get out front of the politics.
I'd like to see questions about that. Entering the room, Chairman Powell on the first Fed News Conference of 2024.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Sheena Smiley from the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay, so what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and it has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, a sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry, if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing, and that tells us that we are gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those two risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down. Growth has been strong. The labor market is strong. what we're trying to do is identify a place where we're really confident about inflation getting back down to 2% so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our teal book, and they're in all the materials that we look at. But you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is implicitly is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around to see the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline, and the case is likely that it will continue to come down. So that's where it is. But we're wanting to see more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes. So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well. The labor market remains strong. If we saw an unexpected weakening certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things, would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down, that's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did, talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering, moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes, and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents, so of course we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation, so the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time. But it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles and has brought that working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest-sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, you know that it's not something you can identify with any precision. But a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate the neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
Thank you. Sorry. Thanks for taking the question, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market. I think you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic? Even with today's ECI levels, they were still above those pre-pandemic.
Back to normal, and you pointed to one or more of them. So I think job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens. It's probably will take a couple of years to get all the way back, and that's okay. That's okay. But we do see. You saw today's ECI reading. The evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. The panic on the part of businesses couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year, and we were kind of thinking, well, maybe we won't get it back. And then 2023 we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to what is still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance, and that's what we want to see. And one great way to look at that is what's happening with wage increases, and you see it now across the major things that we track. It isn't every quarter, but overall there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Chris. Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months. But what's really going to shake out here? What will, when we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE has been running at 1.5%, and there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target, and getting down closer to target is not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have an anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context. We're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
is this the start of when we see a cut? Is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to go, if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria. Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity? And do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast, and then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force, and activity returning and supply chains getting fixed.
Right. So would that be behind why we've seen such strong growth, but we've also seen inflation fall? That maybe there's just a higher level of productivity.
That's
right
one
now?
way to look at it. Yeah.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. we have a built-up set of cities, and people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly, mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation in the necessities of life, right away you're in trouble. Whereas even middle-class people have some scope to absorb higher costs. So we have to it's our job, it's what society's asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them. But we're at the beginning of that process, I would say.
Quick follow-up. Is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately, we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to zero, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to zero. I mean, if it were to stabilize at a different level. But that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up, and the committee will get into all of the issues that will be arising over the course of the next, let's say, year or so.
Thanks, Greg Robb from MarketWatch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a third term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months, and you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good at inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Daniel.
Hi, Chair Powell. Daniel Davis, Agence France-Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years, but nonetheless that's been the case. And we've asked ourselves why that is, and one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for
taking our questions. Brian Menes, CNN Business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy, and I always feel like I spent most of my life in the private sector looking at companies, individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone, that in all their districts they're talking to, not just the business community, but the educational, medical, all nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But that they come back, and what each Reserve Bank president does is during the Outlook go-around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean, if you look back, the last, not this beige book, but the one before, there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing, not in every district and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Let's go to Jeff Cox for the last question.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You had talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now, and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation, are really the main thing we're looking at. Of course, we want the labor market to remain strong, too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
That wraps up the meeting for Chairman Powell, live from New York City. Good afternoon to you all. This is a Bloomberg Surveillance special, The Fed Decides. I think we all need to lie down after the last 1 hour or so. There is 3 steps to this. Step 1, accept you're finished. Chairman Powell saying the policy rate is likely at its peak. Step 2, acknowledge the next step. It's appropriate to dial back at some point this year. And step 3, attempt to explain the threshold to do so. Take a listen.
What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are, in fact, on a path, a sustainable path down to 2% inflation?
That's not good enough for this market. It wants to know about March rate cuts. This is what the chairman had to say.
Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen.
And this is what you get in this market off the back of it all. An equity market that sells off on the S&P 500. Session lows down 1.2%. On the NASDAQ, down 1.5%. In the bond market, we had a big rally. Still got a decent rally, but yields are off the lows of the session. We're down 7 or 8 basis points on a 2-year. 426 on a 10-year, down 5. Lisa, 397.85. We're talking about cuts, kinda. We're just not talking about March.
We were supposed to hear him hug the statement, and he did. He gave this ambiguous answer that
painful.
didn't necessarily say anything at all. We didn't learn anything, and that was exactly what he was hoping for. And then he said the M word, March, and he actually answered the question, and the market responded to that. You know, whether it sticks, we shall see. But that clearly was a signal that was not necessarily in the statement.
TK, they just did not sound comfortable, or at least Chairman Powell does not sound comfortable, suggesting we're cutting anytime soon.
Yeah, bizarre. I mean, the clarity there was the March idea. Claudia Sam out on Twitter saying that was the bombshell. Is clearly they've moved March out of the way. What an odd press conference. I got one word, John: timid. The timidity here, the carefulness is extraordinary. I felt like I was looking at a Bank of Japan meeting from 25 years ago. The point there, they had a data thing that sounded like one of our famous SOT strings, data, and it's just framing out the fear they have and the delay that they're going to cause.
There was something that didn't come up in this news conference. I was surprised there weren't more questions about what happened in the banking system today, what happened with one particular bank, New York Community Bank, because, Lisa, that's what we were talking about in anticipation of the decision for much of today.
It was such an easy question, but I guess it didn't sound very sophisticated. How much do you count that? Does that worry you? Does that factor in? When does that become an issue that actually ends up causing you to cut rates more quickly?
The thing to me here, John, is the behavioral aspect of this meeting. These are smart people. They put on their pants one leg at a time, et cetera. And the answer is the timidity I heard today was just, I've never heard that timidity.
The question, QT. Let's get the folder out. Get to the right page.
That was amazing.
So far, it's gone very well. We had some discussion of the balance sheet. We're planning to have an in-depth discussion in March. We're at the beginning of that process. We see rates and a balance sheet as independent tools. They're not there yet, and I think that's the frustration with markets today. Chairman Powell is deeply pragmatic. He's trying to go through this step by step, have a clear sequence of things. The market wants it right now. Wants to talk about March rate cuts, wants to move Bramo, and that's not what you heard in today's news conference.
Wants to know even what the criteria are. The criteria is when we decide what the criteria will be, and depending on which member. I mean, the idea of the data just needs to continue to be good, and then how long does it need to be good? 6, 7, 8 months? I don't know. We shall see. And that seemed to be sort of this feeling, maybe because each member has a slightly different view as they try to gauge a really uncertain economy.
Thank you for joining us on television and radio, and what we're going to do is talk to people with historical perspective about this moment as we all stagger into 2024. William Dudley, out of Berkeley, on tenure at Goldman Sachs for years, and of course a former New York Federal Reserve president, Bloomberg Economics senior advisor. You know, Bill, I feel like I want to go talk to Eichengreen or Brad DeLong right now out in the hallways at Berkeley. The timidity I see here, the carefulness. Let's start with the why of the moment. Why are they so darn data dependent and careful here to begin a measured trend of lower rates?
I think they're so careful because things are actually going very well. If the economy wasn't as strong as it was, the Fed would be much more inclined to cut rates. But since we've seen very strong growth in the fourth quarter, the Fed's aware of the fact that if they start a little bit later, it's probably not going to have very much consequence for the economic outlook. The fact that financial conditions have eased over the last few months also allows the Fed to be a little bit more cautious. So I think it's really the strength of the economy, the easing of financial conditions means the Federal Reserve is of the view that they can be a little bit more patient. I thought that was a very interesting press conference because up until the point that Chair Powell talked about the March meeting specifically, the market was actually taking it as March was in play, and then he explicitly took it off the table, and the federal fund futures contracts went from pricing in more than 50% probability of a a rate cut in March to significantly less. So I think that was the big surprise at the meeting for me. I thought the other interesting aspect of the meeting was the discussion about the quantitative tightening. So that's clearly being put on the table. They talked about it today. We're going to have an in-depth staff presentation in March. So I think we could expect quantitative tightening tapering to happen sometime, probably around the first half of this year.
Bill, let's unpack some of that. I'll get to QT in a moment. I just want to talk about the strategic ambiguity. So in the statement, this is what they said. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. So obviously, our former colleague, good friend, Judith Smilik of the New York Times, first question out the gate, wants to know what greater confidence actually means. We want to see more data. We're not looking for better data, just more good data. So Bill, dare I ask, what does it mean?
I think what he wants to see is more of the same. I think that's basically what he said. I think they're, a little bit of concern that maybe the really good inflation news that we're seeing is a little bit about goods price weakness, and that may ultimately fade away. So that there might be a little bit more work to do on the services side. So I think that's their concern. I mean, if the inflation news continues along the same course for a few more months, then the Federal Reserve is certainly going to start to cut rates. They're just not absolutely confident that that's where we're going to be 3 or 4 months from now.
Bill, do you think that it was a mistake for Fed Chair Powell to say that March was not on the table?
I don't think it's completely off the table. All he said was, I don't think at the current point that we'll be confident enough in March. But, weak economic data, better inflation news, then he may be confident by the time we get to March. And March meeting is still a ways off. So, his degree of confidence could change between now and then.
Bill Dudley, I look at some of the criticisms here that they're on trend of disinflation. Jason Furman up at Harvard has a wonderful blending of annualized vectors and such. Which vector do you use? If they're on the vector, when do they start? What's the Dudley vector where you measure our disinflation?
Well, I think I think we're still in a very tricky period because we had lots of goods inflation during the pandemic. Then we opened up the economy. That goods inflation went away. In fact, we're actually getting goods deflation now. And the real question is, how long will that goods deflation last? Because if it ends, then inflation pressures could actually start to be more evident again. Offsetting that is the fact that services inflation should also come down as wage gains become more modest. And I think the Employment Cost Index report today was a positive reading that wage trends are becoming more consistent with 2% underlying inflation.
Bill, you mentioned QT. Can we just finish that with you? Did you get the sense from the chairman that he wants to end QT before he starts to reduce interest rates, or that we can see those two things play out independently?
I think they're completely independent. Ending QT is not about loosening monetary policy. It's about basically getting the level of reserves in the banking system down to a level that's as low as possible without the reserve level actually affecting interest rates. So this is totally independent of the decision about whether you want to make monetary policy more accommodative. This is based on the bank's demand for reserves, and the Fed's trying to estimate what that demand is, and they want to make sure that there's enough reserves in the banking system, but not too much. So they want to have a cushion over the bank's underlying demand for reserves, and they're going to try to make, they're going to do the taper to make sure that they approach that place very, very carefully. They recall what happened in September 2019, where we crashed through the level of reserves that banks demanded, and we got an upward spike in repo rates and quite a bit of turmoil in the money market, and the Fed wants to avoid that this time.
Bill, are you surprised that nobody asked about New York Community Bank, and how would you have responded to a question about how that factors into the Fed decision-making process in the next few months?
I think the Fed is not that worried about some of the regional banking issues because I think that they're really bank by bank now. And I think this is all happening in plain sight. This is not like the great financial crisis where you really couldn't evaluate the situation for individual banks. Right now, you can sort of see what's happening to banks' net interest margin. You can see what's happening to the losses on the securities portfolio. You can see what kind of earnings pressure they're under. So I don't think the Fed views the banking system issue as very important right now. Now, could that change? Could something break? And I think the other thing that makes him a little bit more confident about this is long-term interest rates have come down. We peaked, 10-year Treasury yields peaked around 5%, now around 4%. And so that pressure on banks that took a lot of interest rate risks, they're still under pressure. But that pressure is less than it was a year ago.
Going forward, I am curious about Jay Powell and the March discussion. He didn't hug the statement precisely the way that Rich Clarida suggested that maybe he ought to. Do you think that this is actually a sign of how there is Jay Powell, the man, and Jay Powell, the herder of cats, that is the Fed committee? I mean, how much is that basically what we're seeing?
I don't think he really departed from the statement in any meaningful way. I think he just gave a little bit more nuance to what the Fed, how the Fed's thinking is evolving. Obviously, the statement is pretty short and pretty concise, and the Fed's very careful about the changes that they make in the statement. And obviously, in a press conference, you can't be quite that precise. So I thought he tracked the statement quite well.
Bill, what are you thinking? June cut? What's your view now?
I've been thinking May, and I don't see any reason to change that.
May. Bill Dudley, thank you, sir. Former New York Fed President. TK, we got an answer. He's thinking May.
You got an answer. You got an answer for Mr. Powell on March, too. Did you see the market move on March?
Let's get to that market move right now. Equities pulling back by 1.4% on the S&P 500. The Nasdaq is lower as well. Tech earnings were, let's say, underwhelming yesterday after the close. More tech earnings to come tomorrow. Amazon, Meta, Apple still to come Thursday after the close. The Nasdaq is down by 1.7%. I've missed you. Small caps lower by 1.7%. Let's turn to the bond market. 2-year, 10-year, 30-year. The 10-year yield down 4 basis points, 3.99, down 6 on a 2-year. So the Federal Reserve has stepped away from this tightening bias, Bramo, but ultimately, when it starts to engage the rate cut conversation, just not in the way that this market wanted to see it do it. It wanted more than just, okay, things are going well, we need to see a little bit more, but ultimately, the next move might be a cut, and it might be this year, just probably not March, not likely.
Basically, what you're seeing is the market is now pricing in a 38% chance of a March rate cut, down from almost a 60% chance of a rate cut come just before this press conference. The market adjusted. Will it last? We shall see. Tomorrow should be a whole new story. It seems like the Fed is being somewhat consistent toward that May kind of timeline, which is the reason why we've got 91% chance currently priced in.
What was interesting, and we haven't talked about it yet, is just how comfortable he would be with decent growth, strong growth. I think that's a change. You go back to the Jackson Hole Symposium of, what was it, 2022 in August? Pain. And now he's saying basically strength is okay. It's not something we have to work against.
This is basically the Fed not necessarily saying victory, but saying we could get victory, and we're not going to get in the way of it, right? I mean, how much is this a sort of acceptance of this concept that disinflation is good, regardless of whether the strength might suggest that, it could be a problem?
I'll be quicker. I know you want to get to Mike McKee, who was in the press conference. To me, the huge overlay here is gut fear by monetary economics people about getting this wrong. Willie Pesic in Forbes used to write for Bloomberg. Nailed it. Willie Pesic wrote it on the Bank of Japan, and I'm sorry, they are scared stiff of getting this wrong.
They want to see more data, Tom. I'm totally with you. Yeah. You can see they're uncomfortable. Chairman Powell ultimately is still concerned that inflation stabilizes above target. For him, that still seems to be a risk.
It's a risk for all the people who we speak to as well, especially with that strength. What's the bigger fear, though? And this, I think, is different. Is it that inflation reaccelerates, or is it that they do serious damage to a labor market that seems to be in a good place? And that, to me, seems definitely more balanced.
Mike McKee with us now. He was in the news conference. Mike McKee, fantastic work as always, sir. What was your big takeaway, Mike, from that presser?
Well, basically, the Fed has gone to where the market wanted it to be, but they didn't go farther, as you were talking about. They're not giving us a timetable yet, but leaving enough ambiguity that you can try to figure it out on your own. And basically, May comes into the equation then, because by that time, they'll have 3 more PCE inflation data releases, and they'll have a pretty good idea of whether or not we're going to be able to maintain this in the 2% range inflation level level. So I think Powell was just trying to tell people, we've heard you, we see what you see, but we want to make sure that we're not going to be seeing inflation go up again. To what you were just saying, I think they still think inflation is a greater danger. Growth is not a problem at this point. Of course, that was my question to him. They're happy with the way the economy is going. They're happy with the way unemployment is going, and they don't seem to think it's going to get any worse, but there's still an issue about will inflation continue to come down.
Mike, you were in the room, so you've got a better sense of this than us. It felt guarded at times, very scripted. Lisa talked about that. Former Fed Vice Chair Richard Clara talked about that as well in anticipation of the news conference. But did you get the sense that March comment was unscripted? That was off the cuff? That was from the chairman directly?
No, I think that basically he went in ready to say that, probably didn't want to unless he had to, because they never like to put a time frame on anything. But you'll get just one more PCE report before that time, and that's probably not going to be enough for them. So it wasn't that he couldn't say it. I think he didn't want to, but was asked directly about it, so did.
Mike, with Lagarde in the ECB, we parse the hawks. We know who the hawks are. Who are the hawks pushing against Powell's dovishness? Who are the people out there? Bush Cassidy. Who are those guys out there that are hawks right now?
Well, we know that Mickey Bowman has been a hawk and Loretta Mester have been a hawk, but they both have said that they don't necessarily think we're going to need interest rates to rise anymore. So they've at least come to the neutral zone. The question is, will they accept the idea of rate cuts? And I suspect that's going to depend on the data between now and the March meeting, now and the May meeting. At some point, you have to go with what the data are telling you, even if you were afraid that you were going to have to raise rates earlier.
Are you surprised, Mike, that no one asked about the New York Community Bank issue and how much they do have confidence the regional banks truly are in a good spot?
Well, I think the fact that they took the strength of the banking system part out of the statement was a mere coincidence, because the statement would have been drafted yesterday and circulated among them. And, of course, they didn't know anything about New York Community Bank at that point. But I think the reason it didn't really come up is because think about what happened to New York Community Bank. They lost money in a quarter, and stock investors jumped on that because they don't like to lose money. This wasn't a question of a bank going out of business like SVB, which New York Community Bank bought their loans, and that's one of the reasons they had problems. So it doesn't suggest that there's any kind of systemic problem in the banking system like we were worried about last March.
Hey, Mike, thanks for the update. Great work. Mike McKee, out there down in Washington, D.C., just coming out of that news conference with Chairman Powell. Equities TK, near session lows, we're down about 1.5% on the S&P.
I've got greater confidence that Microsoft hit a yearly high yesterday. You know, the market's off, and I really don't know what to make about it. The real yield came back nicely, gyrating off the nominal 10-year yield, 3.99% to me. And Lisa, this goes to your concern over the banking system and other properties in New York City that are really coming under, you know, individual properties coming under pressure. The fact is that 10-year yield's under 4%. That's a real adjustment here. And it's the uncertainty that's out there. And maybe that's what, in the Eccles Building meeting, maybe that's what they were concerned about, the timidity of it.
Although, to me, it seems like he wasn't that concerned about that much, to be completely honest. It's just that he didn't want to get it wrong, and he didn't want to get it wrong on either side, but certainly with the strength also, as you pointed out. The fact that he did indicate that March was off the table, despite some of the signs that people were using to justify it, was significant for the market, and is the reason why we're seeing the market move on that.
We talk, he manages money. Joining us now, Jeffrey Rosenberg from BlackRock. Really, really interesting here on Wither and Forward. How does your view adjust, Jeff? I was thunderstruck by the timidity, the massive, almost comedy on the word data. And you got to go out and run a portfolio. How do you do that given what we observed today?
So, Tom, you're talking about the timidity, and it's in the context where the last two meetings was the opposite from the chairman. There was a lot of confidence. Yeah. I'd characterize it as a little bit of a victory lap. He leaned into the positivity. He leaned into the good news. And here, I think it began with the statement, the inclusion of the new language around needing to have greater confidence was the sign that they're going to push back a bit against market expectations. And it carried over into the press conference. Wasn't clear whether that would happen. It clearly did happen, and it's capped off with this headline that is absolutely the headline takeaway, which is the pushback, hard pushback against the March expectations. And I chalk this timidity up, Tom, to the concern around financial conditions doing too much easing for them and putting at risk the good story that they're having in terms of inflation getting back down to target and right. Growth holding up and not having to have that big decline that Lisa was mentioning that they were warning of, that we thought was going to be necessary to get that inflation down. So it's the risk of losing financial conditions, and markets are just primed for the big green light to go out and back up the truck, and obviously they're disappointed on that today. I think that's a little bit purposeful.
Jeff Rosenberg, Jason Furman up at Harvard teaching Act 10 with my tweet of the day. I love his single sentence observation. I feel like I could be confident enough after 2 more jobs CPI prints. May I suggest that Friday at 8:30, we and the chairman will readjust?
Yeah, I mean, look, he wants to delay here, and there was something that he said that I think hasn't been picked up on, which is the decision to begin cutting is of great consequence. And then he also said earlier, because of that, or because of that concern, there's no need to rush. So waiting for more data and kind of the pushback on what more data do you need isn't really the story here. I don't think they need more data. He kind of said that. We have confidence. We just want even more confidence. I really think they don't want to rush into it. Jonathan Farrow, you asked me after the last payrolls, what is my expectation? I said, June, mainly because I don't see the rush here. And I think that's the story. Is it May? Is it June? It's not March. It's pushing back because they don't want to rush into a cutting cycle.
You said something really interesting there, Jeff, this idea of financial conditions being a concern, that they see the sort of golden pathway and they want to get there so bad that they don't want to disrupt it by giving any more fuel to this market. Do you get that sense, just in general, that if things sort of stay subdued for a bit longer, that'll actually make it easier for the Fed to cut sooner?
Well, the thing that will make it easier for the Fed to cut sooner, and I think Bill Dudley highlighted this, is that the problem is that there's a little bit too much good news on the economic growth side and the labor market side. If they had some weakening, that would make it much easier to say, now we need to cut. It's hard to say you need to cut, and we'll talk about this on Friday morning. The expectations around 265, 280. That's a pretty gangbuster payroll print. Hardly the kind of stuff that says this Fed is too tight. And you saw it in Steve Leisman's question, and I think it will emergingly become a greater focus, which is on the growth side. Yeah. Like, where is the restrictiveness of this policy that you're so confident every time you say policy is restrictive? Is it really as restrictive as we think?
Yeah, Steve Leisman always with some smart questions. John Farrell, let's go to the statistics for Friday. I got 185,000 on survey non-farm payrolls. I got an unemployment rate of 3.8%. That may have a little bit to do with their timidity.
Yeah, I think that speaks to the nervousness. So, Jeff, let's finish on this. Data still looks okay. Payrolls might change that on Friday. For you right now, in this market, putting money to work, what are you advocating for?
I think there's a lot of hemming and hawing today, tomorrow, around the timing of when do they go. But I think if you take a step back from this inside baseball story, the broader story is the Fed has won the battle on inflation. Not totally certain, where we settle in there, but certainly they can begin a cutting cycle. And the growth side is much more positive than what we had thought, particularly when we thought that interest rate sensitivity was going to be greater and recession much more likely. So I think this is a backdrop that is unchanged for taking on more risk in portfolios. It's a better outlook. The credit markets, despite some of the news today in terms of the banking sector, that's particular to commercial real estate. And that is something I think we have to keep an eye on. But you look at the corporate side, you look at the consumer side, it's very strong. And the credit markets here, I think, are strong. There's not a huge price appreciation opportunity, but I think the yield opportunity that you can capture there without the risk of the downside of recession inflation is still the story here.
Hey, Jeff, thank you, sir. I know we're going to do this again later this week, so we'll see you Friday after payrolls. Jeff Rosenberg there of BlackRock. Thank you, buddy. Equities near session lows. We're down 1.5% on the S&P. We're down hard on the NASDAQ as well. TK in the bond market. The move fades just a little bit. Yields are lower by 8 basis points at the front end of the curve.
I'm going to guess for the tech juggernauts, you mentioned it, John. We've got Amazon, I believe, and Apple tomorrow, maybe even Facebook. And the answer is, we're gonna get some tech earnings, some tech joy. But Lisa, I'm sorry, to Jason Furman's comment here, the jobs report on Friday has a new importance.
So maybe if it gets strong enough, then everybody will go back to maybe going to June. And if it's
I
really
think you
weak,
missed what just happened here.
it's-
I confuse him with Jason Furman as well. Yeah, I do too. Jeff Rosenberg.
No, I'm talking about Jason Furman
Jason
at
too?
Harvard and his
Oh, right,
jobs
sure.
matter
Okay.
here.
I confuse them
They're
both.
the
Don't
same
they look the same?
They don't look the same.
I confuse them
Come
too.
on.
No, but they look the same.
I'm going to suggest, John, this
They look
jobs
the same.
report is now really important.
Not all economists look the same, John.
We should do this again.
Yeah, we should.
March 20th. How much do we have to pay you to wake up earlier?
I don't know. Talk to my people.
From Bloomberg World headquarters, I'm Charlie Pellet. 14 minutes to go ahead of the closing bell on this Fed Wednesday. We are looking at losses for the U.S. stock market, not just losses, but right now we are at the worst level of the day on the S&P 500 index, down across the board. 4850 where we stand right now on the S&P, down 75 points, drop now of just about 1.1%. We have got Dow Jones Industrial Average down 0.8 now, down 293 points. The NASDAQ Composite Index down 317. That is a drop right now of 2.1%. 10-year, 3.97% with a 2-year, 4.25%. Stocks saw their biggest decline this year after Fed Chair Jay Powell said the Federal Reserve wants to keep its options open instead of rushing to cut interest rates.
It's a highly consequential decision to start the process of dialing back on restriction. We want to get that right, and we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it.
And speaking after the Fed decision to hold rates, Powell said he does not think it is likely the central bank will cut rates in March. So again, the 10-year now at 3.97%, the 2-year 4.25%. Stocks selling off with the S&P down 75, drop now of 1.5%. Gold down $3 the ounce to 2,033, drop there of 0.2%. West Texas Intermediate crude down 2.6%, 75.81 a barrel, and Bitcoin trading lower by 1.6%, 42,845. Recapping stocks lower, Fed Wednesday, the Dow, the S&P, NASDAQ, all in the red. 13 minutes to go ahead of the closing bell. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, as you know, you just heard from Charlie Pellet, the first Fed decision of the year. It is on the books. As expected, no change to rates. A few changes to the Fed statement. The FOMC saying it does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward that key 2% mark.
Yeah, and a key phrase from today, that March rate cut, Fed Chair Jay Powell says he doesn't think it's likely. Also, Chair Powell saying that he is not declaring victory, that we think we still have a ways to go toward a soft landing.
Yeah, our own Mike McKee asking him, okay, so if not soft landing, hard landing? And he
Love
said,
that question.
Hey, and he also said, hey, it's a good economy right now. This is a good thing in terms of what we're seeing.
He just wants to see more data. He wants to see he wants to make sure that there's not a head fake happening right now.
All right, so a Fed decision, a press conference, questions, all that stuff, and it comes down to they are still data dependent. Right?
Oh, is that what? I've heard that before. I've heard that before.
All right, everybody, we're just about 10 minutes away from the closing bell on this Fed Wednesday. Stocks near their lows, Charlie breaking it down. In terms of rates, we're just a smidge higher all along the curve from before and after that Fed decision. So little reaction. Really, we're seeing it on the equity side of things. So this is, of course, Bloomberg Business Week. Carol Massar, Tim Stenov. Again, coming up, we've got a perfect voice to talk about what the Fed did or didn't do today.
Yeah, we'll be chatting with Frank Sorrentino, the founder, chairman, and CEO at the New Jersey-based and publicly held Connect One Bank Corp, with reaction to the decision and on today's new normal and what's going on with some of the banks out there today.
Yeah, exactly, because some not so good news for another one of the regional players. Tech earnings continue, folks. Qualcomm we have after the close. We're going to break it down. AMD was out last night. AMD CEO Dr. Lisa Su will join us on the chip maker's sluggish forecast. To be fair, she's talking with our Ed Ludlow, but we're going to get those comments. AMD is a big one to watch.
Fed earnings and politics, Carol, feel like this year that's in a nutshell, right? Those three things, at least for us. We got the latest on those pesky and all-important swing states in the U.S. and a rematch between President Biden and Donald Trump.
All right, everybody. So let's get to it. That's your market setup on this Fed Wednesday. Let's get to it with our drive to the close guest. Back with us is Walter Todd, President and Chief Investment Officer over at Greenwood Capital Associates. He is on Zoom from Greenwood, South Carolina. Walter, great to have you here on this Fed day. So did the Fed get it right in your view?
Yeah, I mean, it's definitely a contrast to what we heard in December, honestly. So I'm a little bit confused. I'm glad I wasn't taking a drink every time the word confidence was used in the press conference.
He did say good economy several times, though.
Yeah, no, absolutely. I think, obviously the market's a little bit disappointed. You saw the expectations for the March rate cut drop from like 60% to 40%.
What are we so disappointed about, considering he did say over and over again, it's a good economy. People are working. We've got growth. Inflation continues to come down. Like, what is it that you think equity investors might be getting wrong here? Or do you not think they're getting it wrong?
Yeah, no, I don't think they're getting it wrong. I just think it's just, again, a near-term reaction to an expectation, not unlike what we've seen in a lot of earnings reports this year in terms of what the expectation levels are. So we're still about 5% above that level that we were before the December meeting. So, we could continue to drift a little bit lower. But, I mean, there's 40 days between the March meeting and the May meeting, so I don't think it's that big of a deal than pushing it out.
Do you think it's the right move? I mean, is what you're hearing from Fed Chair Powell, in your opinion, the right thing for him and the Fed to be thinking about right now? Do you agree that the Fed needs to see more data in order to declare victory on inflation?
Personally, no, I don't think they do. And actually, we heard from Powell in December saying they really didn't need more data, but yet now they do. So they need better or growing confidence or more confidence, whatever the phrase is. So again, I think we're kind of splitting hairs on the timing. I think they could certainly go ahead in March, given what we know today. But there's a big gap between today and the March meeting. So we'll get a lot more data. We'll get a lot more data this week and see if it continues.
Carol, he did say we will begin rolling back tight policy sometime this year, the Fed chair.
Well, yeah, right.
Sometime this year. That was like the hint that he gave for, okay, yeah, we get your message here. We're just not going to tell you that it's going to be in March.
Right. Well, and I think that's fair. I mean, right. I mean, Walter, it comes down to we do expect rate cuts of some sort. It's just quantity and when it all starts. So that's just the question. I mean, I feel like he was very, very clear of kind of taking March off the table. He is concerned about pesky inflation, and he's worried about you hit it. It's like a tag game, right? Tag football or something, or whatever you want to call it. Hitting it, and then what if it goes above 2%? That is his ultimate end game here, correct?
Yeah, but he's very clear about what the ultimate end game was. The only kind of thing I would push back on is, in December, it seemed very clear they were kind of where they needed to be and had seen what they needed to see. And I think, I expected him to push back at that December meeting. He didn't. So maybe this is a little bit of a replay that he gets here in January to push back on financial conditions easing so dramatically since that meeting.
Just a headline to bring to everyone's attention. Fed swaps cut odds of a March rate hike to contract low near 30%, Carol. So
for the March meeting.
For the March meeting.
Yeah, that's
March rate cut.
Yeah, no surprise. If you've got Jay Powell coming out.
We're like, okay, we're listening, but there's still a 30% chance.
Well, because. Go ahead, please. No,
I was just going to say, they basically just pushed it out, right? I mean, if you look at the January 2025 number, that actually went up. So they're just pushing out. They didn't take away cuts. They actually added half of a cut for the remainder of the year, but they pushed it out beyond March. So they are listening, but they aren't listening because he said, the Fed has 3 in their dot plot. The market's still pricing in over 5 this year, but they just pushed it out beyond March.
Hey, Walter, is there anything in the Fed decision, and especially since you feel like a little bit of a disconnect from what we heard in December and what we're hearing today, that would impact your portfolio strategy for clients?
No, not really. I mean, I think, you use opportunities like this, given the strong move that we had at the end of last year. You use these pullbacks to, put new money to work, take opportunities to buy names that, maybe you were waiting on a pullback on and put additional capital there.
Is this enough of a pullback, or do you think there's further to go?
I think there's probably more to go, and I think you need to be mindful of the earnings events, obviously for individual names, because that can create further pullbacks in individual names. But I would not be surprised to see us kind of leap back maybe towards that level that we were in mid-December before we kind of reset and move higher.
Hey, there's valuations to watch, and then there's also earnings fundamentals. So far on that front, what is that telling you about the corporate environment right now and the ability to maybe maintain earnings going out through 2024?
Yeah, it's a great question. I mean, it's really kind of tough to figure out because you're getting such mixed signals from different companies. Witness UPS yesterday versus GM, for example. I would say in general they're okay, but not great. The growth is definitely concentrated in a pocket of the market, as we know. So I'm very interested to continue. I have a list of calls that I need to listen to hear more data, but I would say it's okay right now.
What's on that list of calls? What's on that list of calls when you've got some downtime that you're going to listen to? What are the companies that you think bear your listening to?
Oh gosh, well, as of today, I mean, I want to go back and listen to Starbucks. I've got Boeing to listen to, AMD, Google. I'm really kind of behind, honestly. So,
given how much work you have to do, we're glad you came on our program. Thank you for doing
this.
Yeah,
no question. But even listening to we don't own UPS, but I listened to that call this morning just to kind of understand the dynamic and what was going on there. So even listening to companies that you don't own just to get a better kind of signal on things.
Hey, just 30 seconds from you on that. We continue to get news of layoffs every single day. Odyssey plans to cut jobs in its Pineapple podcast division. Flexport has laid off 15%. Novavax is cutting 12% of its global workforce. Yesterday it was UPS. What do you make of all this? I mean, are we looking at, is it too anecdotal, or is the data actually coming in?
No, I think you are starting to see softer kind of data. Powell alluded to this in the labor market. I mean, the ADP report today wasn't too great, 100,000. So, I mean, that to me, that's the key for this year, right? If we continue to see positive job gains of 100, 150,000, that's fine. But if we start to see negative prints there, if some of these anecdotal stories show up in the actual numbers, then we got a problem, I think.
Yeah, and the Fed chair is saying he doesn't want to see the job market fall apart. Hoping to keep that dual mandate in mind, inflation low, but still people working, and maybe ideally, ultimately, say we are at that soft landing. Walter, thank you so much. As Tim said, you're in the midst of a lot of stuff, so glad you could take some time for us. Walter Todd.
Absolutely.
President and Chief Investment Officer over at Greenwood Capital Associates on Zoom from Greenwood, South Carolina. Folks, we've got equities near their lows, yields a little bit higher. Time to head over to our TV colleagues Beyond the Bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with Carol Masser and Tim Stenovic, matching in lovely blue. We welcome our audiences across all of our Bloomberg platforms, television, radio,
didn't get the
originals,
memo.
and YouTube. I sent Scarlett a completely separate email. It's like a joke I have with her.
I like to stand out
We're
with
all
my
wearing
outfit.
white today, Scarlett.
You always stand out.
But look, I mean, we have to talk, of course, about the big news. The Fed meeting today, and really the market reaction to it, guys. And we're looking at one of the bigger sell-offs that we've seen in the equity space, and of course, one of the bigger rallies that we've seen in the Treasury space in a while.
Yeah, right. That's certainly significant. We've seen that play off of it. Walter Todd, that we were just talking from Greenwood Capital, saying, you know, I'm a little confused. I felt like the Fed was saying one thing in December and Jay Powell was saying one thing, and now it's like, what, March is completely off the table here, it feels like. So he felt like the mood was different, and then for equity investors, that meant, well, wait a minute, our expectations were too high, so we've got to pull back a little bit.
The message, though, is clear from Fed Chair Powell. He wants to see inflation come down. He wants it to be consistent. He doesn't want to get burned by 6 months of data. He wants to see more than 6 months of data, Scarlett. He doesn't, you know, it's the concern, of course, is that it's, you know, the data that we've seen in recent months doesn't stick, and that's why he's telling people you have to be prepared for us to keep rates higher for longer.
Yeah, for equity investors, the data coming out of companies like Alphabet and Microsoft was certainly nothing to celebrate, especially given how much those stocks had rallied after the last earnings report. Don't forget, Alphabet, Microsoft, big chunks of the S&P 500, the NASDAQ. We've got another 3 companies reporting tomorrow that can really set the tone for the rest of earnings season.
Yeah, this was such a weird confluence of events this week with all the big earnings, a big Fed meeting, and of course, we still got more economic data, consequential economic data on Friday with that jobs report number. But you're seeing a lot of weakness right now in the markets here. They had kind of oscillated around earlier in the session, but after Jay Powell started speaking here, the direction really shifted to the downside. The Dow Jones Industrial Average lower by more than 300 points, or about 0.8%. The S&P is going to close out the day down about 1.6%, biggest one-day drop for the S&P going back to September 21st of last year, now camped out at that 48, 46 level. The NASDAQ Composite down more than 2%, its worst day since late October, and the Russell 2000, guys, down about 2.5%, Carol.
All right, folks, let's get to Qualcomm earnings just crossing, and let's get to the outlook because it's talking about second quarter revenue, the outlook here, 8.9 to 9.7 billion. Quite a range. The estimate out there on the street, 9.36 billion. First quarter adjusted revenue, 9.92 billion. Folks, that is a beat. The estimate on the street is 9.54 billion. So that initially, first quarter adjusted EPS, 275. Again, a big beat. The estimate on the street is $2.36 a share. And initially, Scarlett, we're seeing the stock up about 1.7% here.
Yeah, Qualcomm, of course, so critical in the smartphone market, and it's really kind of a barometer for demand for smartphones, which we know has slowed down, particularly in big markets like China for someone like Apple. So the fact that this revenue outlook is so broad leaves a lot of questions in my mind. It's going to really depend on how the company characterizes what it sees out there during the earnings call.
Cristiano Amon, in a press release, the president and CEO of Qualcomm, saying, looking ahead, we're building on the momentum with our leading Snapdragon platforms and tech differentiation and connectivity, computing and on-device generative AI across handsets, automotive, PC, XR, and industrial Internet of Things, Romain.
Yeah, I mean, this is going to be the big story. I think everyone is really so focused right now on the health of the mobile market and obviously Qualcomm's space in it. And of course, we'll get a much better read on that when we get those Apple earnings in a couple days' time.
What's really interesting, too, is, you know, we've got to keep an idea of whether or not, in terms of the PC side a little bit, like that is something we've been talking about a lot with the chips in general. But again, giving this revenue forecast for the current quarter in line with analyst estimates, recovering market, as they say, for smartphone chips. And you do wonder if there's an AI play here as well as they look at that part of the market as well.
Yeah, we talk again about handsets. It should be noted here that revenue from handsets for Qualcomm rose 16% in the fourth quarter, the fiscal fourth quarter, compared with a 27% drop in the previous 3 months. So there was a recovery, but the question is, how does that look going forward?
Yeah, exactly. All right, Qualcomm guys, we're going to keep a watch as we continue to go through the press release and comments, still up about 1.7% in the aftermarket. Let's get to some of the individual gainers, if I may, in this session. Paramount among them, a top gainer in the S&P 500 today. You know the story, we've been covering it at Bloomberg. Byron Allen, he's been making big plays, big bets in the media space, making a $14.3 billion bid to buy all of the outstanding shares of Paramount Global. It's about $28.58 a share. It's about a 50-cent premium for the voting stock. It involves voting and non-voting shares, I should point out, according to those in the know, including debt. It's a deal about $30 billion, but Paramount, really an outperformer, up more than 6% in today's trade. Boeing also moving to the upside today. It did report revenue and free cash flow for the fourth quarter that beat analyst expectations. It's been on our radar amid all the worries over its 737 MAX lineup, if you will, and certainly the concerns there. Company, by the way, racing to complete a key engineering fix needed to certify the smallest version of its cash cow. Of course, again, we're talking about the 737 MAX jetliner, but nonetheless, investors giving some love to that one, up more than 5%. One more, ADP. We don't talk about it a lot. It does a lot of back office operations for companies, human resources, payroll, stuff like that. It was a top gainer in the NASDAQ 100. Earnings this morning, solid earnings beat and a positive revenue growth forecast. What it says to me is we are constantly watching these earnings reports, and it's really moving the names certainly at this time.
Well, quite a few notable decliners to get to. I do want to start with New York Community Bank Corp, plunging a record 46% at one point in the session before paring some of those losses, finishing down 37% on the day. This finishing falling the most since 1993. It did report a surprise loss tied to deteriorating credit quality, and it made a cut to its dividend. The company said it wants to build up loan loss reserves to be better in line with other banks of its size and get ahead of potential weakness in the office and multifamily property sectors. This is a big one. We got Frank Sorrentino on a little bit later from Connect One Bank. We're going to be talking to him all about it and what New York Community Bank Corp results mean across the sector. Also, got to talk about this tech companies reporting late yesterday and how they finished on the day. Let's take a look at Alphabet, ticker GOOGL. Shares finishing down 7.5%, biggest intraday drop in months. The company reported Google advertising revenue that was weaker than expected. And then AMD, another stock that reported yesterday, falling on the day today, finishing the day down by 2.5%. The chipmaker gave a revenue forecast that was weaker than expected, though analysts said that the guidance, even though it was particularly weak, they were encouraged by the ramp in its AI accelerators, Romain.
All right, let's take a look at what's going on in the Treasury market here, because it was a really wild day here. We started off the day with the Treasury market much more focused on that Treasury refunding announcement. Basically, the details here of the durations, the size of the durations that they plan to sell in the quarter here. And then, of course, you got that news out of New York Bank Corp that you were just talking about. That also sent Treasuries much lower here on the day. And then we got that Fed meeting. The net effect of it all is we're down about 11 basis points on the 2 and the 10-year yield is down by about 10 basis points here on the day, but it was much more severe than that at one point. So what you're seeing is a little bit of a clawback of that, and it's kind of hard to even know whether these moves are actually because of the Fed, and because of the regional banking issues, or because of the Treasury fund announcement. Maybe the answer is all of the above.
All of the above, probably. That brings to mind the next question, which is we have more data. We talked about how this is a monumental week with the FOMC, with big earnings. The jobs data comes up on Friday. Does that matter as much as we once thought it did, given what Jay Powell has told us?
I think it does. Yeah. I mean, I think there's going to be, after today's kind of soft report that we got today in the employment market, private payrolls at least, I think it does matter. If there's significant deterioration there, then that's kind of, bad news is good news. And I think if they show that there's significant hiring this month, because it is still January, then that's not so good news.
I'm confused, Tim, because Al said that he was looking for good news. So is he looking for bad news, or is he looking for
No, he doesn't want the labor market to fall apart, right?
He
Didn't
doesn't,
he make that
but
very
if
clear?
the labor market does fall apart, then you can expect rate cuts sooner than later.
That's a market's interpretation.
Yeah.
Yeah, Powell wouldn't say that.
Yeah. Are you still confused, Romain?
Yeah.
Scarlett explained it.
I was born confused.
Okay. All right. Thanks, Scarlett.
I don't know. I felt like Jay Powell was really clear. Like he says, okay, we're at peak policy, guys. We're taking March off the table. Although he said May. Like I really feel like every meeting still is a live meeting, so we have to be smart about that. I just think he kind of laid it out, like that there's a lot of good momentum. Or Mike McKee trying to say, okay, if you're not going to call it a soft landing, do you call it a hard landing? He
dodged that one.
Right, he did. But he said, listen, there's a lot of good stuff out there, right? We're glad people are still working. Yes, it's softening in the labor market. We're going to watch that very closely. But I think this is the delicate part as you get to the end of a monetary policy.
Yeah, but they're very careful. He was very careful to not get too far ahead, right? We're not declaring victory. We have a ways to go. We're not saying mission accomplished on a soft landing, even though Janet Yellen, the Treasury Secretary, has said just that.
Yeah, well, she's not in the seat anymore, so it's easier. Listen, I think bottom line, data dependent.
She's still important, right?
Well, no, she's absolutely important, but she's,
she's the one selling all that debt that we can't afford. So,
I thought it was really interesting.
Give her a break.
I thought it was interesting in the simulcast. That's very fair, but it was just reminding that you can tell Jay Powell takes this very seriously, because when they were asking him, asking some of the guests about politics and so on and so forth, like you can tell he takes the dual mandate really seriously. I think.
Yeah, his expression for some of the answers, he looked like he was pained to answer some of the questions.
Well, yeah, you feel like he's like, okay, I'm done.
He's like,
if I had to stand in front of a bunch of journalists, I'd be pained too.
It's like quantify greater
we're a
confidence.
motley
Unfortunately,
bunch,
you have to
that's
do
for
that all
sure.
day, Roman.
All right, guys, that's a wrap. Our cross-platform on this Fed Wednesday, radio, TV, YouTube, Bloomberg Originals. We're wrapping it up. A little bit of earnings as well, but we will see you again, same time tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, it is a Fed Wednesday. It's also still, we're thick in the earnings season. Qualcomm out. The stock is up about 2.5% here in the aftermarket. So the Qualcomm forecast meeting estimates, giving that revenue forecast for the current quarter that was in line with analyst estimates, helped by a recovering market for smartphone chips. We know that they're moving into AI areas. They're also looking into the PC area. But when it comes down to it, it's their bread and butter and then some. It's all about those smartphone chips.
Yeah. Analysts wanted to see $9.36 billion when it came to fiscal second quarter revenue. Sales, the company said, will be $8.9 billion to $9.7 billion. Excluding certain items, profit will be $2.20 to $2.40 a share in the current quarter versus an average projection of $2.26 per quarter. We got a great voice on this.
We do. Lynn Dewan in the studio, making her way here, managing editor of technology and global security at Bloomberg News. She is here in our Interactive Brokers studio. Okay. First, gut reaction. How'd they do?
We were wrong. We were all wrong. I feel like it was just like a week ago. We were like, AI winners, not AI losers. And then you have Qualcomm, and Qualcomm is like as boring as you can get. They're like in headphones. They're trying to make it into cars. Right? They're like in the non-sexy, and they may be the only ones in the past 24 hours
So who
that are
cares
actually
what they're
winning.
trying to get into? What matters
like,
is what they are into.
Yeah, it's forming the narrative over the last 24 hours. You saw Microsoft earnings disappointed on AI, Alphabet disappointed on AI. AMD has been trying to make itself like an AI chip maker like NVIDIA. They disappointed on AI, and then here comes Qualcomm. Smartphone recovery, headsets, like, that's interesting.
Okay, so I'm glad you said this because Cristiano Amon, who is the president and CEO of Qualcomm, said that they're not just, of course, interested in handsets and automotive that you mentioned, but he said we're going to build on the momentum with our leading Snapdragon platforms and tech differentiation and connectivity, computing, on-device generative AI. Do we care about that?
Well, I mean, you see how diversified he's getting, right?
Is he that diversified now, or
that's where they're getting? I mean, they are the company that is known for putting their putting their eggs in a lot of different baskets, and in a lot of ones that are like rooted in emerging technologies that haven't yet proven themselves out. But in some ways, this quarter has been good for that because you don't have your eggs all in one basket like AI, and like the revenue outlook and the profit outlook are. You can't say they're great, but the fact that they're not bad compared to what was reported yesterday afternoon is what's bolstering their stock today.
Well, to be fair, that range, I'm like doing quick math here, but that two-quarter revenue outlook, $8.9 billion to $9.7, the estimate's $9.36. I mean, that's pretty much exactly smack
it's
in
like
the middle.
not blowing anything out of the water. And so like it
Exactly.
says something about where tech investors are right now, which is like they're okay with not bad. Like they're okay. Like they don't have to be blown out of the water.
The estimate's in there,
right? The estimate's in line. Yeah.
I think that's fair to a certain extent, given the run-up in the NASDAQ 100 and the run-up in the S&P 500, and that, it seems like, Carol, almost every other day we're talking about new records, and for some of these individual companies, we're talking new records.
Yeah, that's... So are you talking valuations?
I'm talking valuations, yeah.
So we're coming back to earth on some of.
Do you think so?
It's a 21.
I hope so.
Or a lot of this stuff was priced in. Well, again, not asking you for investment advice. Don't worry.
Well, it's a 21 PE, a forward-looking PE of not quite 16. That seems reasonable.
it feels reasonable, and I feel like investors are kind of like coming around to the idea that they just need to be in the reasonable range now, more realistic, like less, euphoria and hype. I mean, I think this is like the first real quarter, honestly, where investors are kind of like, all right, great, we're over the knee-jerk reaction of AI. Now show us where it's actually contributing to your bottom line. And being Qualcomm, being like the diversified player that they are, they're like, look, we don't have just AI to offer, and we're offering good bread and butter results that are in line. Like, we're a steady, reliable company. I mean, that's the message that they're sending.
Because there was, I think, worries that smartphone demand has been kind of sluggish.
Yeah.
So how do you cross that thinking with what we got from Qualcomm?
I think that'll be really interesting. Like, the big telling moment is going to be tomorrow.
Apple.
Right? Apple. Yeah. Like, that says something about Apple. And, also, what says something about Apple is when Verizon and AT&T and T-Mobile are reported. They're usually trying to steal each other's share. This time around, they all reported gains in new wireless customers. So, like, maybe Qualcomm combined with all the telecoms will say something about tomorrow's Apple. I am not one to make forecasts. I don't make predictions,
but there is a
that's
connection.
interesting.
There is a connection. We should note shares of Apple in the after hours are up about 0.7%. So, Lynn, can we say anything about the health of the PC industry and the health of the smartphone market in general, Apple notwithstanding? I mean, Apple's certainly a big player in both of those. By reading into Qualcomm's results?
I mean, Qualcomm certainly did not signal a rebound. It just signaled health, right, and stability. And if you look at the other chips earnings thus far, granted, we haven't gotten NVIDIA back and some of the others, but if you look at them thus far, it paints a very nuanced picture. I'm not ready to declare that we are over the chips glut. I'm not ready to say that. I don't think that's what the earnings have panned out to say either.
It's
not
been
even
there's
Qualcomm's.
cross currents, right? Was it ASML that was like off the charts, and then we had AMD.
Texas Instruments was
lackluster, yeah.
It's interesting too. I'm looking at Qualcomm. Tim knows this. Like, one of my favorite functions on the Bloomberg is the supply chain. And you mentioned Apple. Like, 27% of Qualcomm's revenue is coming from Apple. About 21% from Samsung. I mean,
so watch that, right?
Is like about 6%.
But how consistent is the Apple revenue moving forward, given that Apple wants to do more of this stuff in-house? Like, can Qualcomm still rely on Apple moving forward?
That's a good question.
And maybe I got to ask Mark Gurman about that.
Mark Gurman will tell you that Apple is like very much in the business of diversifying its supply chain and getting all over.
And there's been some fighting between Apple and Qualcomm in recent years.
And there's been some fighting between Apple and some of its other sources like abroad. So I can't say where that relationship is going. I mean, clearly all of these big tech companies are starting to do a lot in-house, both by way of like trying to invest in manufacturing and chips design. So we'll see where that goes. I mean, maybe they'll offer up some commentary about it in this earnings call today.
Well, that's what I wanted to get to. So, okay, we're going to hear from them probably any moment now. What are top of mind questions for the Qualcomm C-suite?
Rebound is going to be the big one.
For smartphones?
Does that mean a rebound in smartphones? But remember that they also have a very big market in headsets, especially in Asia. Like, Asia is a big market for them, so people are going to want to know whether there is strength there and whether there's going to be a recovery in demand there. I mean, clearly people are going to want to know like how the telecom sales like correlate into demand for them. I think that's going to be the big question for Qualcomm. And AI.
All right, AI. See, it's still important. It's still important. All right, Linda Wan, thank you so much. We know it's a busy day. Managing editor of Technology and Global Cybersecurity, a really great voice for us to rely on as these earnings come down here at Bloomberg News. She joins us, of course, in studio.
Well, as you know, a lot of tech companies weighing in this week with earnings. Important tech companies, and we just heard from Qualcomm. Another one we heard from about 24 hours ago, AMD, Advanced Micro Devices, which traded down nearly 4% following earnings about 24 hours ago.
And earlier today, Bloomberg Technology co-host Ed Ludlow caught up with AMD CEO Dr. Lisa Su, asking what gives her confidence for the really strong set of predictions and growth outlook the company gave for the market in AI accelerators, and what data points she relies on for that upbeat outlook.
we look at AI, when I look at the potential of AI, it is really the, single most important, technology innovation over the last 50 years. So AI has so much potential to, change the way our businesses work, to change our personal productivity, to really change the way we do research and a whole bunch of things. From our standpoint, we see the AI TAM growing to upwards of, $400 billion by 2027. I think from an AMD standpoint, you were at our launch, Ed, in December. It was a great coming out party for the AMD, AI capabilities, and it's gone really well. I think our customer interactions, our product qualifications, our ramp have gone really well. So we were able to update, some of our numbers this past week.
I think a lot of folks focused on that ramp and how it went in the quarter. You exceeded the 400 million that you told me about at that event. So it's $3.5 billion of sales this year for MI300. What's interesting here is kind of your ramp relative to what's happening on the supply side. And I wondered how big a factor supply will be in matching or beating that number in 24.
Yeah, absolutely, Ed. This is the fastest product ramp, in our history. So, we exceeded our numbers in Q4, over 400 million. We're going to grow into Q1, and we updated our full year forecast from 2 billion to 3.5 billion. The way we think about that is that's a customer demand statement. So that is customers that we've engaged in, who have made commitments to us, who have placed orders with us. We're planning for a much larger number as it relates to the supply chain. This is what we should do. We always plan for success. So, my view is it's still very, very early in the innings for AI accelerators, and particularly for MI300. But this is an opportunity for us to, continue to build a major growth driver as we work with our top customers on their AI plans.
And Lisa, just to clarify in layman's terms, so your expectation is the supply available to you from a volume perspective in 24 will be greater than the $3.5 billion in demand that you feel confident in right now?
That's absolutely right, Ed.
So you and I talked about this kind of change in what's happening in the use case of AI accelerators, moving from a predominantly training-focused environment to inference. And I think I'm right in saying you're confident that AMD is going to play a key role in that inference part. But there's also the question of when the psychology of the customer changes. And I think one question that one of the analysts covering the stock had, Pierre Ferragu, was on the show with me earlier, is when do the customers commit? When do they basically say, we've got good visibility on our training and now inference demands over a multi-year horizon?
Yeah, I think, Ed, as always, when we're dealing with, deep partnerships like we have, across, sort of the hyperscalers, at our event, we mentioned, Microsoft, Oracle, Meta, all committing to adopt MI300. We really plan multi-year roadmaps as well as, capabilities. So I'm super happy with how things have gone. I think key in all this is the devil is in the details. The engineering is really important. We've made tremendous amount of progress over the last couple of months. You've heard directly from one of our customers, Microsoft. Kevin Scott talked about the work that they've been doing with their most important workloads around ChatGPT and its capabilities. We have confidence that from a performance standpoint, we can be very competitive. And from that standpoint, the customer conversations are multi-year, multi-generational conversations. We certainly have good visibility in terms of exact orders for the next couple of quarters. But more importantly, we're planning, how is this market going to grow and how do we grow together, going forward?
Lisa, where are we at with PC and everyday server demand?
Well, it's a good question. I think we've gone through some ups and downs in the PC market and the traditional server market. I think what we saw is a nice recovery into the second half of the year. So we were very pleased with our performance, frankly, in traditional server in the second half of the year. We grew strong double digits, and more importantly, what we see is our products are getting a lot of traction. So Our Genoa or our Zen 4 product line has ramped really nicely. As we go into 2024, my expectation is that the server market will grow and that we will grow significantly faster than the market, just given the strength of our product portfolio. And there are a lot of data center refreshes, going on. So that's the server market. And you also asked about the PC market. I think the PC market also recovered nicely in the second half of the year. In general, the PC market tends to be a little bit seasonal, so the second half is stronger than the first half. And then we see that also in 2024. But we also see the PC market growing, let's call it low single digits, here in 2024. And within that, the very exciting part about the PC market is AI PCs, which we think can grow substantially faster.
Lisa, the tension in the share reaction is exactly that. Enthusiasm for MI300 and concern about a recovery in end markets elsewhere. How do you see the tension between those two product lines, essentially, for you evolving in this current period and throughout 24?
I'm actually really excited about 24. I start every year always quite optimistic, but I look at 24 as, such an important year for us. I think, 23 was when we established ourselves as, a key AI contender. I think 24, we're going to show just how capable and how much, AI is now part of, really the entire AMD story. And in terms of the other markets, look, I like PCs. I think traditional server is going to recover nicely as well. And, put aside some of the temporal things. We've said that, revenue will be more second half weighted in 24. I think we feel really good about the setup going into the next few quarters, given the strength of our product portfolio and also, the great, customer partnerships that we have.
All right, that is Bloomberg Technology co-host Ed Ludlow catching up with AMD CEO Dr. Lisa Su. All right, from big cap tech to banking we go. ConnectOne Bancorp reported earnings last week. Fourth quarter GAAP EPS, 1 penny better than analyst consensus. Revenue, a little bit of a miss. Sales coming in at $61.82 million versus an analyst estimate, Tim, of $63.03 million.
Okay, following earnings, 3 analysts raising their price targets. Shares of ConnectOne have rallied nearly 50% since October 27th. The stock up 2.4% year-to-date versus a gain of 0.7% for the KRE, the S&P Regional Bank ETF.
All right, so back with us on the business and what he describes as the new normal, Frank Sorrentino, founder, chairman, and CEO at the New Jersey-based and publicly held ConnectOne Bancorp, today joining us from West Palm Beach, Florida. Hey, Frank, so good to have you here with us. Welcome back. Happy New Year. Did the Fed get it right today? Why or why not?
Happy New Year to everybody. Great to be back. And I think the Fed did exactly what we all in the banking industry expected that they would do. Inflation is still a concern of theirs. There's still some work to do on the balance sheet. They reiterated their stance that they are going to continue their QT program and continue to take dollars off their balance sheet. And they're going to sit pat with rates until they see data that confirms that inflation is absolutely under control. And with the strong employment numbers that we keep seeing month after month, they're not getting that data as quickly as everyone else would like to see it, right? Everyone wants to see interest rates come down. I think we're going to see them in this range of altitude for quite a while.
Well, that's exactly where I want to go with this, because you guys do a ton with real estate and construction and small business. So remind everybody about your business mix, exposure to sectors, and more importantly, what you're seeing out there right now and what you project to see in the next few months.
I'm not sure if it was the last time I was on or a couple of times ago, but someone asked me what I thought the economy was going to look like as we got into the end of the year and into 24, and I said robust, and everybody sort of lost it.
I remember that.
But that is the sentiment. When we here at ConnectOne speak to our clients and they talk about business opportunities and the environment in which we're in, everyone, I don't want to say they're bullish, but they're optimistic about the future. And yes, interest rates are certainly higher than where they were 2 years ago, 3 years ago, 5 years ago. But let's not forget, that was an abnormal place. Zero interest rates really don't exist for any period of time in any economy. And actually, the interest rate environment we're in today but for the inverted nature of the curve, is more normal than what we've seen in the last 10 or 15 years. So look, I believe, and we have these conversations with our clients, if you can't make money in your business with a 6, 7, or 8% interest rate, a true cost of money, then something might be wrong other than the interest rates themselves.
That's interesting.
Our home builders are seeing that, our manufacturers are seeing that, and other segments that we're involved in are seeing that they can actually make money, they can attract good talent, they can get capital at these interest rates and still make money.
So that when you hear the news about New York Community Bank Corp, also another regional bank player, a record 46 intraday loss or haircut in its share price after reporting a surprise loss tied to a deteriorating credit quality and a cut to its dividend as it's getting ready to meet stricter capital requirements. Is that a one-off? Is this one of those folks who are like, why can't you make money in this environment? What does that say? And are you seeing any signs of that?
Look, I think there are a lot of things going on in that story that you would have to really parse and get under the cover of. They bought a large defaulted portfolio through the FDIC from Signature Bank. They are mostly a multifamily lender in the New York City market. They had a fairly good-sized office exposure. They are approaching or just over the $100 billion mark, which puts them in a different category from a regulatory exposure. So you add all of those things up. None of those things are actually a great place to be at the moment. You put them all together, I'm just not sure. I don't know enough and really wouldn't want to comment without having more specifics around all of those facts. But when you add that string of things up, it's no wonder that they're having some challenges in the marketplace today.
Because you know the sector so well, Frank, I'm wondering if you see the problems at New York Community Bank Corp spreading potentially to other banks out there.
Look, we've been talking for a long time about issues within the real estate space. And if you recall, if we went back 2 or 3 years ago, even before COVID, retail was a really bad 4-letter word, and anybody that had exposure in retail, we had to spend an inordinate amount of time. And we spoke on this program about retail exposure in banks. Today, retail is one of the strongest segments in commercial real estate.
Right.
It's renting. Some of the vacancy rates there are at the lowest they've been in 30 years. So, there's a constant refreshment when it comes to real estate and real estate uses. As we went through COVID and came out of COVID, office became a problem. All office? No, not really. Individual office spaces, certain types of office, B class, C class, maybe central business district office where vacancy rates were the lowest. So again, you got to really parse the numbers and dive into what's happening. Same thing now is going on with multifamily. Multifamily, everyone thinks is a problem all by itself, but it really isn't. It's where you have rent stabilized multifamily. So the banks that have larger portfolios of rent stabilized are going to have more issues and challenges.
Right.
And those that don't won't.
We talk about the different tiers of real estate. It's really important. Having said that, Frank, your company's shares also got caught in the New York Community Bank Corp downdraft, down 4.5% on that news as well. Here's a moment to say, are you seeing any deteriorating credit quality? Are you looking to cut your dividend? You raised it last year.
We just had our earnings call last week, and we announced that we were pretty optimistic about the year ahead, and we've had a track record of raising our dividend, and that we would likely be raising our dividend in this next quarter. Our credit is near pristine, like every other bank in the industry. There are one-offs, and by the way, here's another metric that people are looking at. Charge-offs for banks have been, forget about historic lows, they've been at 0, which is just doesn't make any sense for the banking industry. We are in the risk business. There should be a certain amount of charge-offs.
Right.
We're still not back to what's normalized charge-offs within the industry yet. When some bank, announces an extraordinary number, everybody suffers for a day or two. I don't think it's going to impact us going forward. We have a great optimistic business plan going forward. Our clients and our markets are doing well, and I feel pretty confident about what's happening in 24.
One last question. We can feel your confidence. 40 seconds. So consumer business side of your business, nothing. You're not seeing any kind of financial stress, and just very quickly, if you could.
Well, again, not seeing any stress is probably could take it a little too far. Of course, there's individual challenges in various places And look, banks need to work with their clients, and we're seeing that in a lot of places. But overall, when you look at the U.S. economy, you look at the employment rate, the fact that people have jobs, the fact that we're manufacturing everything here in the United States, the fact that we have so much going on to the positive, I see a pretty bright picture ahead.
Well, listen, we always appreciate getting some time with you. Frank, be well. Frank Sorrentino, founder, chairman, CEO at Connect One Bancorp, joining us on Zoom from Florida.
Florida nice this time of year, Carol.
It's
February.
Much better than a gray January here in New York City.
New York or New Jersey. Hey,
rough.
let's see how things are in Washington, D.C. and get a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 991 newsroom there. Hey, Nance.
Hey, Tim. The White House is identifying the group responsible for the weekend attack in Jordan that killed 3 American troops. This is National Security Council spokesman John Kirby.
We believe that the attack in Jordan was planned, resourced, and facilitated by an umbrella group called the Islamic Resistance in Iraq, which contains multiple groups, including Kataib Hezbollah.
Kirby says the first retaliatory action taken by the Biden administration will likely not be the last. The CEOs of the world's largest social media platforms were called on the carpet today on Capitol Hill over their efforts to protect kids online. Meta CEO Mark Zuckerberg says it's been a challenge since the internet began.
We work closely with law enforcement to find bad actors and help bring them to justice. But the difficult reality is that no matter how much we invest or how effective our tools are, there's always more to learn and more improvements to make.
But members of the Senate Judiciary Committee say they're not doing enough. Ranking Republican Lindsey Graham.
Mr. Zuckerberg, you and the companies before us, I know you don't mean it to be so, but you have blood on your hands.
Senator Graham highlighted the case of a child who'd been sexually exploited online. The CEOs of X, TikTok, Snapchat, and Discord were also grilled at this hearing. More than half of swing state voters would not vote for Donald Trump if he were convicted of a crime. That's according to a new Bloomberg News Morning Consult poll. It's a warning for the Republican frontrunner. A new Quinnipiac poll shows President Biden is widening his lead over Trump 50 to 44% in a hypothetical general election matchup. Back in December, the same poll had Biden at 47%, Trump at 46%. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons.
Bloomberg World Headquarters. I'm Charlie Pellet. 440 on Wall Street. Qualcomm shares just dipping early after an earlier move higher. Qualcomm out with a revenue forecast for the current quarter that was in line with analyst estimates, helped by a recovering market for smartphone chips. Right now, we've got Qualcomm after hours down now by 1.5%. Lynn Dwan is a tech managing editor for Bloomberg News.
Over the last 24 hours, you saw Microsoft earnings disappointed on AI, Alphabet disappointed on AI. AMD has been trying to make itself like an AI chip maker like NVIDIA. They disappointed on AI, and then here comes Qualcomm. Smartphone recovery, headsets, like, that's interesting.
And she was a guest right here on Bloomberg Business Week. The other big story today, stocks sold off after Fed Chair Jay Powell said a March rate cut is unlikely. Walter Todd is president and chief investment officer at Greenwood Capital Associates and interviewed right here on Bloomberg Business Week. He told us we are not done with the selling.
I think there's probably more to go, and I think you need to be mindful of the earnings events, obviously for individual names, because that can create further pullbacks in individual names. But I would not be surprised to see us kind of leak back maybe towards that level that we were in mid-December before we kind of reset and move higher.
And you can hear more of that conversation on the Bloomberg Business Week podcast. And just to update you now on Qualcomm, the stock is selling off even more after hours. Qualcomm down now by roughly 3%. Fed Wednesday, move lower today for the U.S. stock market with the Dow, the S&P, and NASDAQ all declining. S&P 500 index lower by 79 points, down 1.6%. The Dow dropped 317, down 0.8%. NASDAQ, the composite index, down 345, a drop there of 2.3%. 10-year yield, 3.92% with a 2-year, 4.20%. Spot gold up $1.50 the ounce to $20.38. Little change there, up less than 0.1%. Bitcoin lower by 2.7%, 42,380 on Bitcoin. Crude, West Texas Intermediate, down 2.6%, 75.78 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, throughout the year, we're going to refer back to our Bloomberg Morning Consult polls. They tell us what's going on in the key swing states ahead of this year's presidential election. To that end, some new data today that offers some really interesting insight into how voters are thinking about President Biden and former President Trump.
All right, so let's get to it. Let's bring in Gregory Cordy. He is Bloomberg News White House and politics reporter. He joins us from our Washington, D.C. bureau. Gregory, so good to have you here with us. These polls, we look forward to kind of a little bit of a gut check of where we are in what is expected to be another rematch between President Joe Biden and former President Donald Trump. So let's get to it. What did the poll find out and show us or reveal?
Yeah, so I think this is the fourth time I've been on with you guys to talk about our monthly poll, and this is the one that we've really started to see some movement, not necessarily in the candidates, but certainly in the issue environment. So the economy obviously has been a drag on President Joe Biden and his approval ratings. We've started to see, obviously, in the economic indicators with inflation ebbing a little bit. We're starting to see that in public opinion. It's a very slight decrease in the number of people who say the economy is on the wrong track. And it's a slight decrease in the number of people who say the economy is their most important issue in who they're going to vote for in November. But what that's doing is it's leaving some room for some other issues to percolate up. And the issue that's percolating up.
Can I just say, on the economy, it's remarkable in a day where the Fed Chair Jay Powell said in his press conference, hey, folks, it's a good economy. Like, there's a lot of good numbers out there. So it's interesting in terms of reality and what our Fed Chair thinks and what numbers are saying versus polls. But please continue.
No, that's a very good point. And we've been waiting for this, right? We've been seeing the economy moving in the right direction, and that hasn't been reflected in the polls. We're starting to see that. But what that means is that as people's concerns about the economy subside a little bit, that leaves some room for them to worry about some other things. And the thing that they're worried about is the border. They're worried about immigration. And that's another issue where former President Trump sort of has the high ground over President Biden on by a 22-point margin. Voters trust Trump more than Biden on the border. That's a 5-point increase from the last time we did this poll. And they're blaming Biden for what's going on at the border. 61% of voters say that it's Biden who is at fault for this huge influx of migrants. Now, I should say these are swing state voters. We only polled in 7 swing states. But those are the states that are most likely to decide this election.
Gregory, that's what I wanted to get to. I mean, is the way the border is it viewed equally in the swing states that are actually border states versus those that are not border states?
The one border state, as you look at that map, is Arizona is the one swing state that is on the border, and voters in Arizona have a much more sort of nuanced version, a view of the border debate because they live it all the time. They're less likely to vilify the migrants themselves, but they're also more likely to say that the border is an issue. But one of the things that we were maybe surprised about, maybe we shouldn't have been, is just how big of an issue this is far away from the border. It's a huge issue in Pennsylvania. It's an issue in North Carolina. Not quite as much in Michigan. But every other state, it's the #2 issue.
You know, I do wonder if people were hidden in the cave and couldn't watch TV or check their phones, and they weren't kind of hearing the constant news beat, if you will, or what, critics would say that, the GOP is putting out the immigration issue front and center. Would people continue to put immigration high? Like, in other words, would they feel like they were being impacted by immigrants coming in if they were kind of away from the news noise, if you will?
Carol, it's a very interesting point, a very good point, because one of the things that we're seeing is that Republicans are much more likely to be moving on this immigration issue than independents or Democrats. And you can't ignore the news aspect of this. I checked with Media Matters, which is a media watchdog. They tend to be more liberal, but they monitor the number of segments that different news channels give to the border issue. The number of segments on Fox News on the border issue has increased threefold since November. And it's more than twice as CNN and MSNBC combined. So certainly conservative voters are getting deluged with information about what's going on at the border, less so for people who tune into maybe more centrist or left-wing news organizations.
Okay, so another poll that I wanted to get to, results of another poll, Gregory, is about what happens if former President Trump, is convicted of a crime. Some really interesting data coming out from the Bloomberg News Morning Consult poll. Talk to us a little bit about what we learned.
Yeah, overall on the top line, 53% of registered voters in these swing states say they could not vote for former President Trump if he were convicted of a crime. But what's really interesting to me is that even many Republican voters, including some who say they will vote for him in 2024, say their opinion will change if Trump were convicted, and especially if he's sentenced to prison for one of these 4 criminal cases that he's been indicted on. And so if that sticks, and I have a reason to believe that at least some of it will, because some of these Republicans said they would be very unwilling to vote for Trump if he were convicted. That's enough maybe to change the narrative. Now, President Trump is leading in a lot of these swing states. The conviction issue could be a game changer, but that all depends on whether any of these trials can actually happen between now and November. Obviously, Trump's legal team is really
that was what I wanted to get to, Gregory. I mean, this stuff, it seems to be the tactic is delay. We only have a minute left, but there's a lot of delaying going on here. The former president needs to campaign. What are the chances that there is some sort of event like this between now and the election?
Yeah, I mean, that's a very good question. And at one point last year, it seemed like all of these indictments, all these prosecutors were all lining up trying to get first in line. But they all have different procedural hurdles. There's a huge amount of discovery. I'm thinking of the Mar-a-Lago case, the case involving classified documents. Obviously, a lot of sensitive issues there. These January 6th cases are very involved. The hush money case in New York is the simplest case, but legal analysts say it's also the weakest case. And there's this issue that's now before federal appeals courts about whether he had presidential immunity on the January 6th cases. So there's a lot of moving pieces with the legal things. If it gets to a conviction, it's a game changer, but it might not get that.
When's your next poll? When do you do the next one?
We do this every month. We're going to do this every month between now and November, and it gives us a chance to really kind of track the economy over time and how people perceive it, and also to ask some new questions every month about different issues.
Well, certainly look forward to it, and great checking in with you. Thank you so much, Gregory Corti.
Thank you.
Yeah, White House and politics reporter at Bloomberg News from our Washington, D.C. bureau. What do you think?
If I'm not mistaken, I heard an interview with Gregory very early this morning about this exact story, and I'm talking like it was dark outside, so I think he's been doing this all day.
Or maybe he took an 8-hour nap in between.
Yeah, I don't know about that.
Probably
He's shaking his head. I don't think he took a nap. staff. Yeah, really appreciate you
They
joining us,
work
Greg.
hard in Washington.
They certainly do.
All right, you're listening and watching Bloomberg Business Week.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Among today's earnings, NASDAQ reported fourth quarter net revenue that beat estimates. NASDAQ, though, planning to cut hundreds of jobs as it integrates software provider Adenza into its business, an acquisition it closed last year amid efforts to propel a new phase of expansion at the firm. Adita Friedman is NASDAQ's chair and CEO, and she spoke this morning with Bloomberg Radio.
When we announced the deal, we announced $80 million of net expense synergies, and then over a medium to long term, $50 to $100 million of revenue synergies from cross-selling and expanding the business. So we do feel like we're on track on both fronts. I would say that with the expense synergies, we have a very clear plan, a very clear path of execution. We expect to achieve that over the next 2 years. And then we have an upcoming investor day, and we'll provide more details to our investors around that.
And today we had NASDAQ down 1.2%. Wall Street, though, looking ahead to tomorrow's tech earnings from Meta Platforms, Amazon, and Apple. Today, AMD, Alphabet, Microsoft all declined today after earnings. Microsoft lower by 2.7% today. We had AMD down 2.5%. Alphabet, though, hardest hit percentage-wise. Alphabet today down by 7.4%. Walt Disney's lawsuit accusing Florida Governor Ron DeSantis of politically retaliating against the company has been dismissed by a federal judge. U.S. District Judge Alan Windsor in Tallahassee, Florida, today granted DeSantis' request to throw out the company's suit, saying that the Walt Disney Company lacked standing to sue the governor. And those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody. Tim and I getting ready to wrap up on this Fed Wednesday, the Wednesday edition of Bloomberg Business Week. Do not go anywhere, though, because a lot coming your way over the next few hours, including Daybreak Asia. That starts in a little bit of, 2 hours from now, Doug?
3, who's counting?
3 hours.
Who's counting? Doug, you got to turn your microphone on.
Sorry,
when you're in
3,
the
who's
studio.
counting?
I know you just began your career in radio, but when the red light's on,
I'm up for grabs.
when the red light is on, it means the microphone works. Hey, did you, by any chance, what were you doing from 2 o'clock to about 3:30 today?
I was listening to some of the press conference today. I think the big news was the fact that Powell seemed to push back on this idea of a March rate cut.
Yeah, I
right?
agree with you about that.
Yeah.
Do you think it's off the table? Carol says it's off the table. We had some pushback from Bill Dudley on Bloomberg TV earlier today. He's like, it's not off the table. It just, right now he's not ready to commit to it.
Is one of the things you have to worry about if you send a wrong signal to the market, and I say wrong in view of what the Fed would not want to see right now, which is an easing of financial conditions, which means higher stocks, higher bond prices, lower yields. That's
what's happening right now.
Well, yes, and I mean, you could make the case that if he clearly indicated that they were going to go ahead in March and begin cutting, that we'd been off to the races.
The
today.
floodgates would be open.
Right. So they're pushing back against that idea. You may be right. The data may support the idea of going in March, but I think the Fed just doesn't want it to create too much enthusiasm prematurely.
I think he said, though, even looking at, what was it, 6 months of inflation data, and then it says kind of, we're there or almost there, if you will. You can hear in his voice, he just wants to make sure it sticks, right? That it's sticky at that 2% rate, that we don't go above it again. And that's what he's looking for.
That's a real risk. When you look at the volatility that we have seen in energy, I mean, up one day, down the next, a lot of uncertainties as they relate to what's going on in the Mideast.
Yeah.
But Jeff Gundlach was on CNBC today saying that basically he's concerned or betting that inflation will kind of stall here, that we're not going to see much more in the way of decline. He's also, and I thought this interesting, that he was going to continue to look for a recession this year. So, we're not really seeing early indications of that. The labor market remains tight.
Jobs report, not
Well,
jobs
but we're
report,
seeing a lot
the
in the way of
earnings.
job cuts.
That's what I wanted to get to.
Right.
Yeah. Even more today, we saw Novavax cutting jobs. We saw Kimberly-Clark cutting some jobs.
Right.
Yeah.
So how are those job cuts being handled? I mean, is it through attrition?
Yeah.
We talked yesterday about the work from home. Those folks maybe having a target on their back in some cases.
Everybody's talking about this right now.
About what?
About the working from home is like you are the target
Pariah.
of. Sorry?
You become a pariah.
Exactly.
Right.
Yeah. I mean, what a shift that we've seen.
It's amazing if you could go back, everything's changing. You're going to be able to work from home forever. I think it's an interesting moment. I keep being struck by how many times Jay Powell was like, it's a good economy. There's good data. This is good. I just think he wants to make, as I said to somebody, or we talked about yesterday, I used to do gymnastics. You want to make sure the landing sticks, right? He wants to make sure that 2% inflation stays there. And he'd like to see the job market not fall apart.
There's a lot that's very dynamic going into a presidential election year, right? And he was asked during the press conferences, what his feelings would be if he were not, let's say, tapped to serve another 6-year term. And he just kind of, ducked that question.
Doing my job.
Right, doing my job. We're focused on, the job at hand, the task at hand.
That was a pretty remarkable answer to me.
What? I think it was very Jay Powell or very much ahead of a Fed answer.
But a reminder of literally, it's like, do you think he dreams about the dual mandate? Like he's 100% focused on the dual mandate. Like this is a guy who's stable prices, maximum employment, stable prices, maximum employment.
And then the other story that is very